Open and fund a new tasty drink.
Good morning, everybody. We've had a real last minute. I don't even have my computer on mute. Welcome to the show. It's myself, Rich McDonald, and Tom with us this morning.
Good morning, Rich. It's been a while.
That was a crazy last minute pit stop.
It was running in, doing my bit.
Because there is so much to talk about this morning. We have got TSMC to report on. We have got a lot of UK numbers.
Indeed.
And then just look at what else is coming up on today's show. Well, Tom Roberts is through with us till 8:15. Angeline's going to come in and give him a little bit of a test on the fast markets there till 8:30. Then we've got psychology of trading. So Isar is coming in to give his wisdom and intelligence, let's say. All sessions opening bell will take you through what is going on. If there's any read-through from those TSMC results, you'll see the US stocks open at 9. And we've got Garth McKenzie. That is a new face. For those of you that listen to his podcasts on your iPod, then you'll recognize the name. So we got Garth coming in there at 9:10. And then we've got John Meyer, really interesting stuff in the mining world last week, so we're replaying that at 9:35.
I had one of the original iPods, those big, thick, white ones, 2006, 5.
But you've got some dance moves, Tom.
I've got some dad moves, probably. That's what my kids call it.
Well, do you know what? Speaking of that, well, I had a few dad moves out last night. So
where were you?
It was... So every Wednesday, well, we've done a 10-week course. I've been going to my Alpha course, which is on Wednesday evening in South Kensington. I do believe some of my group, we've got a group of 11 of us that go every week. And I think some of them are in the chat there this morning. I see Kemi. Actually, we've got a picture. Let's get a picture up of the team. So we had our last group meeting yesterday, but also had a little party afterwards.
Love a little party.
This is a great thing called Alpha, and 36 million people have now done this across the world.
Okay.
And it's looking into, people when they've got questions around faith, when they've got questions around all the good community things that are done in the community. Then this is the
at Brompton Oratory.
That's right. Yeah. HTB. Yeah. Right behind the oratory. But just incredible.
Good for you, Rich. Like that.
Yeah.
Good. You enjoyed it? Have you enjoyed the course?
It's fantastic.
Good.
And the speakers that they've got that come in.
Yeah.
I actually first did it about 12 years ago, but I didn't finish it. I only made it to week 3.
And now you've done 10 weeks.
Graduated last night.
Very well done.
But yeah, so then they got the DJ out, and we were dancing in the middle of a church.
There you are, folks. Rich McDonald spinning the decks.
Things that you thought you'd never hear this morning, team. So yeah, good morning to everybody on the chat there, and good morning to you all. Buenos dias to Maturin. Andrew McKelvey saying that EasyJet are complaining
about the French.
Imagine that. Good morning, Darok and JC as well. And also, we had our 2 phones there saying that they tune in from America just before they go to sleep. And this is the way that they prepare for the...
On the West Coast? They must be on the West Coast then,
yeah. Came back with an answer there, actually. But yeah, I'm assuming it's on the West Coast there.
And to Andrew McKelvey, we will have a quick catch up on EasyJet as well. Q3 results from there. As you mentioned, Rich, lots going on UK corporate diary wise. People interested in the UK markets open this morning. We'll talk about it in a bit, but Ocado, EasyJet, Frasers.
All this morning.
SSE, Dunelm, Wise, Diploma. So there's quite a lot going on there.
Good stuff. Right, well, we better go into overnight action then if we've got that much to cover. That's right. The big question, is he going to sack him or not? That was the big move down yesterday in markets when Trump had to deny that he was about to fire the knucklehead that is the Fed chief, Jerome Powell. So were you on the floor yesterday when this was all going off?
Yes, I was.
Bit frantic?
Yes. But as I was talking to the guys this morning, for the markets then to drop and then suddenly come back again, and for Trump to say, I would like him to resign, I don't want to fire him.
Yeah.
It's just an outrageous statement. As someone said this morning, Jimmy Carter had to sell his
Thank you very much, Phil.
Jimmy Carter had to sell his peanut farm when he became president to make everything okay and make sure he didn't have any outside interest.
It's a different world now, though, isn't
And
it?
it is a completely different world. And
Not necessarily a better one.
Luke's brought up a stat. Luke Moore, one of the regulars on this show, brought up a quote from Twitter saying this morning, the market cap of the S&P 500 is about $50 trillion. So today's adventure, talking about yesterday, wiped off about 250 billion in minutes, only to restore that sum when Trump denied the rumour. To put this in context, that's nearly $1,000 per American citizen.
Well,
I
if
was like,
that's
that's
all
brilliant.
it is, then just get on with it. Yeah. But I think you've got to expect that Powell could at any point step down because he's getting strong-armed.
Absolutely, and I think Powell will have the decency to sort of think, I've had enough. I'm done here.
Yeah.
I've had enough. I'm off, and I don't want to deal with this anymore.
Because I would imagine he will continue to refuse to be.
I agree.
To move interest rates. I think he would resign before he cut rates.
Correct. He doesn't want to be seen as the person that is
Destroy central bank independence.
or being put under so much pressure. He doesn't be the person that has to pull the trigger in effect.
Yeah. So there's of course questions whether it can even happen. There was a 1970 amendment to the 1913 Federal Reserve Act that says he cannot fire him unless it's with cause.
So we didn't know, we were talking on the desk about this morning, and for the viewers out there, we didn't know if there was actually legality there that Trump cannot actually fire him in legal terms, but can ask him to step aside or resign.
Oh yeah.
But cannot physically remove him.
Yeah. I mean, anybody can ask
Knowing
somebody
Trump,
to step
but
down.
knowing Trump, it might be, you are fired. Pardon the expression, but we can sort of see him. Yeah, we can almost see him doing that.
No, but he can't. He absolutely can't unless there's cause, and that's why he's going for him on the $2.5 billion restoration of the Federal Reserve. It's not bad. We're spending about the same on the studio. So. The botch job, as they're calling it. Apparently, Powell didn't have full clearance to go ahead with it. Yeah, right. And then Powell's defense is actually, look, we spent 2.5 billion, but we were going to have a roof garden and we took that out. So I haven't done anything wrong. We just be careful. That's all I would say, is that could come at any point.
Yes.
And I don't think he's going to fire him, but that's not the way these things happen, right?
But as you say, Rich, he may just step down, remove himself from the theatre of conflict, let's say.
Yeah.
Yeah.
After being threatened with something else.
Yeah. Right.
But that's not what's going on at Diageo. Diageo, she's gone. Chief executive steps down after 2 difficult years. It has been a very tricky years.
Yeah, and this came out yesterday. Deborah Crew, she stepped down. She's had 2 years in the seat, and the statement was that she was leaving, I think, of immediate effect and by mutual agreement.
Yeah.
But as you say, it's been a tricky 24 months.
Yeah. With profit warning after month 5, I think. But I think there are a lot of people who are deciding to drink non-alcoholic versions. So she has had a tricky time.
Have we got a chart of Diageo? I mean, it's been...
Well, yeah, it's It's not very pretty.
No, I mean, if you look at the last, when's that? 2
That's
years.
since she
That's 2
joined.
years. Yeah. So you've gone from £34 down to about 19, 18.
I must admit, I bought some on the announcement.
You did?
Yeah.
Right.
However that value destruction's come about, you'll now have a new CEO come in. There'll be a strategic
We don't know who that is yet, though, do we?
No, the CFO is
The interim. Yeah.
but they're searching for somebody. You know, say that's a big name and they come in and she does a strategic review. Even before the strategic review goes out, it could be 22, 24 quid.
Yep.
And then Guinness gets sold off. You take 10 billion there. There's a little bit of new blood and new life could give some inspiration into this.
Yeah. Selling off Guinness, receiving circa 10, you are selling off your prize asset at that point.
Oh, well,
what does the growth look like?
Yeah, you still hold a percentage of it. You know, if you just IPO it.
Yeah.
But I mean, something has to be done to extract the value that's in that conglomerate. But yeah, maybe tequila and whiskey might not be the way forward. So it has its problems, and those aren't going to be fixed straight away. But I just feel that the city's
There's potential there.
Yeah, the city's outlook on it might change a little bit.
Does it pay a dividend?
Oh, Diageo, yeah,
Decent one.
yeah, decent, yeah.
Yeah.
So that's our Diageo there. What else have we got? We've got an opinion piece from Alistair Osborne as well. That's the chief business commentator in the Times. There you go. That's hangovers for you. Some go away all by themselves. Others need more drastic action. And that is certainly what happened at Diageo yesterday. Shall we go down to his conclusion and see what that is? Is an ex-numbers man from Coca-Cola Euro-Pacific Partners really the ideal leader? Crew has lost the trust of investors, had to go, but the shares rose by a mere 0.5%, implying this is no quick fix. Manzoni has his work cut out ensuring investors end up with something to drink to.
Yeah.
That's fair, isn't it? Good. Right, what else you got for us, Tom?
Do you see also just in below that Barclays find yesterday? Did you see that? 42 million.
Right. Failings on financial crime risk.
Correct, yeah. Small number in terms of who Barclays are, what their revenues are. Still 42 million is a decent fine from the FCA.
Yeah.
So
That'll
keep
pay
an eye
for
on with that.
restoration of their offices.
But that came across yesterday on the wires, and we saw that. So do just keep an eye on other banks as well, because the FCA are scrutinising the high street banks a little bit more on really on what I think Barclays have started this, but keep an eye on Lloyds, NatWest, etc. this morning. This morning, as I said, quite a lot going on results-wise, UK-wise. We were talking on the desk. I don't know if you've seen the TSMC numbers, Rich, that came out earlier this morning.
Surprise.
Q2 earnings, yes. The actual number, 61% profit uplift to 398.3 billion, estimated 376 billion. That will be in Taiwanese dollars. Great numbers coming out of there this morning. Volvo as well, another one that appeared early doors this morning. Earnings beat on there. But TSMC, very interesting, especially in light of obviously potential US earnings coming out this week as well.
The margin, so the margin guidance was operating margin 55.5 to 57.5. That would be down from 58.6 in Q2. And then their operating margin guidance is similar, move lower to 45.5 to 47.5 from 49.6. So I'm not sure whether that's just giving themselves room or there is actually some changes afoot, because of course 75% of their market is America. So it's not like, it's Taiwan to China. It is Taiwan to Apple, Nvidia, AMD and Qualcomm.
So there's a quote here, TSMC, the world's largest contract chip maker, posted 60% surge, etc. Beating market forecasts and netting a historic high as it benefits from surging demand. And also it says, really interesting to see what will happen with America, especially with the customers like Apple, Nvidia, and how much they've made. They've put in their April to June net profit rise of 398 billion. I mean, it's a huge number.
Yeah.
Put it in context with viewers, that's about 14 billion US dollars. So that's a big beat and a big number. So good coming out of there. See what the read across is to the US. Like that.
Not so good in Swatch. Swatch, poor numbers. You ever had a Swatch watch?
I have. And actually, my boys both like a Swatch as well.
All right.
But Swatch, I feel, is a market that I don't go looking for a Swatch, but if I'm at the airport, I'll go and have a nosy.
Bit of spare time.
But that's 3 hours in a year or whatever it is that I go to an airport. Therefore, when do I go and buy a Swatch? I really don't. So it doesn't surprise me in a lot of ways. I feel like it's a dying breed, unfortunately.
I'm taking the over on 3 hours is the amount of time you spend in an airport per year. Just a small trade.
Yeah.
Right, there's the Swatch price graph, so you can see.
I mean, that is awful.
Yeah. So, hardly a surprise that there is a big miss there. But, 60 down to 28.
Yeah.
That reminds me of another stock that we covered yesterday with that profit warning. Let's have a look at where Renault finished. It was ugly. It finished right on the 33.63 level, which was down 18%. And let's have a little look at how that traded during the day. It did, of course, sell off as the American investors came in. You can see, as we said, over the morning, it opened at 35.20, I think, and then dropped down to as low as 33.80, which is just above where it closed at 4:30, 33.63 last night.
Watch that again
Dismal.
this morning. See how that continues. We touched on some UK earnings this morning. To answer Andrew McKelvey, EasyJet Q3 headline profits pre-tax 286 versus a 236 year on year. So that's 286 versus 236 year on year for their Q3 headline profit. That's pre-tax. Keeping on EasyJet, Ocado.
Let's just have a look at what the article is saying there. A hit to annual profit from higher fuel costs and the strike, even as the airline expects good profit growth. So that's a bit mixed messages there.
So headline profit, I've got the details here come through from Bloomberg. Headline Q3 pre-tax profit up 21%. They've said there's a positive outlook for FY25. Sees FY25 growth of about 9% year on year. Passenger load has come in just above last year, though. So 25.8 versus 25.6. And as I said, revenues coming in somewhere around about 292 versus 2.89 billion.
Right, so we'll keep you up to date there. If we get a guide, we've got some research from Numis there. Numis saying that it's an inline Q3, but Q4 outlook points explicitly to higher costs and softer RASK. As a result, reasonable to infer at least 5% potential downside risk to consensus PBT. So doesn't look good from EasyJet there this morning.
Yeah. So keep an eye on that. We've got two big ones to talk about here. Frasers, they've had some numbers out this morning. Full year gross margin coming in at 47%. They've had their final results, by the way. Sees adjusted pre-tax at 550 million to 600 million. That looks in line. Revenue is down though, 4.9 billion versus 5.25. So revenue down. They have said they've cut some costs, and it looks like their margin's coming in about 46%. So mixed numbers there, but put it in perspective, revenue's down to 7.5%. They're saying, sorry.
Yeah.
Yeah.
Right, we will have indications soon. It is 7:51, and we'll just wait for the indications to come through. So we will go to chart of the day 1 minute earlier than expected. But if you are watching, especially from my Alpha group, good morning to all you. I see Kemi's on the chat there. If you're watching and you haven't subscribed, please hit that subscribe button there just below us. We've got 1,260 subscribers right now.
Fantastic.
That's decent week.
That is very good. Very good.
It's better growth than Diageo.
Indeed. And they're all coming on to see you. I love it.
No, they heard you were on this morning, Tom.
Now, yesterday's chart was Kingfisher, wasn't it? I think that you brought up yesterday.
That's right.
So interesting to see today. It's
This is the first time we've gone head to head, actually.
I just know I won't get this one, but we'll have a go.
So, Douyin, good morning. And good morning, R6 Centre. Thank you for that. Vodafone's earning date, 22nd of July. We'll definitely do that one morning in fast markets. That's next week?
Next Tuesday.
Next Tuesday. Great. Okay, what country is the chart of the day from? It's the USA, United States. What's it going to be? What's it going to be? Ready? 3, 2, 1, go. Right, we're going to keep that one going as a surprise for you. But yeah, we thought we'd come back in because there is quite a lot to get through this morning. Obviously, we've had a reasonable overnight in Asia. We've had Nikkei up 0.5%. We've had the Hang Seng up as well. But the futures are looking good because Europe closed in the dire concerns of the Trump doing his apprentice.
Trump-Powell discussion. All looks pretty blue on our screens this morning from an index point of view. If the viewers are looking at it, we've got 5 minutes to go. FTSE will probably break 9,000 again today, I think. It's up, being called up 29 at the moment, 89.75. Well, you know, you've got to be positive in this world, Rich. US tech futures up 70 points. S&P up 7 points. This is all obviously via the futures. DAX looking positive this morning as well.
Yeah, very.
Up 0.6. And France up 0.6% as well. With the stockies as well, EU stock is up 1.1% as well. So
yeah,
all
why
looking...
is Eurostock so much stronger than the DAX? That's a bit weird. Not often we see.
Yeah.
Must be something up a lot in Europe that we haven't seen yet. oil as it was, gold down. So gold hit 33.65 yesterday on that ridiculous rumor. That's easy for me to say, isn't it? Willis Wadwick. Then we've got 133.81. That's new lows for sterling. So dollar regaining all of its strength there that it lost. It dropped 1.2% on that rumor yesterday, and the dollar strength is not helping copper. Copper 552, along with iron ore up strong again. So the iron ore names, we've been covering this the last couple of mornings. Just watch Rios. And
I heard you talk about this yesterday. For the viewers out there, I worked for IG in Melbourne for 4 years.
yeah.
I mean, the Aussies love an iron ore play. They love a small cap Western Australian miner. They love iron ore. It's difficult to trade. Trades out of an exchange in China, and also out of the US. But the Rios play, it is a great market to keep an eye on. And when iron ore is booming, the whole of Australia is booming as well. Yeah. It is almost what everyone centres around. But it's an interesting one to trade as well.
So it has been pretty dismal, hasn't it? Yeah, I'm going to have a look at that one on the open this morning. Of course, I've already got Anglos. I've got some Diageo. I'm short some BHP against my Anglos because going into the close yesterday, you didn't really know what to do, right? You couldn't really run an overnight risk knowing that markets could be down 5%, and the end of central bank independence as President Trump fires his central bank chairman.
Rich, on the Eurostocks, you sort of piqued my interest there. Why against the DAX? I wonder if, because ASML took a real hammering, didn't it, yesterday? It was down like 11-12%.
It was.
I wonder if it's getting a bit of a bounce today that's then driving up the Eurostocks a little bit.
Funny you say that, because I've just had a research report through. I'm trying to see who it's come from. ASML stock dropped 11% post Q2 earnings, justified by increased uncertainty for full year. But the long-term growth and market leadership story remains intact.
Yep.
Management's refusal to guide for 26 is due to short-term macro and geopolitical risk, not a deterioration in business fundamentals. Service revenue, now 27% of the total, is a growing stabilizer. Double-digit growth expected through 2030 with margin expansion potential. This person's view is it's a contrarian long-term buying opportunity as the stock approaches intrinsic value.
In line with that, closed last night 625.
What, did it get down to?
It's being called this morning. There's still 2 minutes to go, so do take this with a pinch of salt, viewers. It's being called at 654.
That's annoying.
Which is a 5% uplift, or 4.6% uplift, but it's still moving around in the auction at the moment.
I wish I'd put a alert on that yesterday.
Yeah. Closed really on its lows, didn't it?
I do wish I'd put
so that might be driving the Eurostoxx up slightly more than the DAX, because this is an Amsterdam-based listed stock.
And then, of course, let's have a look at that into the close. So the rumours started, was it about 4 o'clock?
Yes.
God, just look at the way the Americans trade this as well.
Driven it down, yeah.
That was at 2:30 on the US Open, and then it was really driven. So I can see at 640. I would buy them at 640. I might put a little order in there. So buying 20 at 641.
Because the US.
Where's it uncrossing now? Sorry, Tom.
Bear with, uncrossing at 651. It looks like at the moment. Still a minute to go.
I'll go 642, just in case it dips down there.
Where's the closed at 625.8?
Right, there we go. Grab your bell, Tom Roberts. We are about to ring. No, you not got it?
Yeah.
Go on, give it a ring there.
Ready? Pathetic effort.
Right, we are off and running. So Lloyd's is straight up there. Lloyd's up 2% and back towards its breakout level. 78 pence is as high we saw it. Get up to 79 maybe? Lloyd's hold
78.5, I think it was, wasn't it? To get
only 2.6% on ASML.
yeah, 17. Oh,
I must have them at 640 then.
Just frozen.
Did I get?
I've got 643 trading. Hang on.
Yes, I got them. Perfect.
You did.
Yeah. Good.
See if they have a bit of a bounce there.
Right, so we're long some ASML at 641, I think it was, 642. Yeah, 642. And Lloyd's waits until Tom Roberts comes on the show to break out. Up 2.3 this morning. WPP also recovering, but from a lower low, it got down as much as 413 yesterday.
Yeah.
HSBC, strong morning. Smiths is, and Scottish Mortgage Investment Trust, Luke Moore will be happy with that, up at £10.60.
And Scottish Mortgage Investment Trust, one of their holdings is TSMC.
What I don't see there is Rios. Where's Rios? Why am I not getting Rio Tinto? There we go. Up 20 basis points. I'll have some of that. Right, we're buying 300 Rios.
Barclays having a bounce from yesterday as well, after their fine. Sorry.
But I like this Rios trade because, as we said, iron ore was up 1.5% and Rios is only up 15 basis points.
Yes. 19 basis points, up 9 pence, it looks like. 44.10.
Oh, I'm going to go bigger than that. I like that one. Right, we'll buy another 300 there at 44.09 for Rio. So we're now in Rio Tinto. Start the Carnival. Right, Renault, let's go to Europe because we're seeing a lot of action in Europe. We've got ASML up 2.5% now. That is at 641. So that's back to where it was as the Americans smashed it down on the Wall Street Open yesterday. Are you a believer in ASML for the long term or continued fallout from their warning yesterday?
Schneider having a run. Haven't seen anything on that.
Could well have had numbers this morning. I think it's a Thursday reporter. Air France up 1.2. Oh, we haven't checked EasyJet that. We'll check that for you in a minute. But yeah, the German autos are decent. And on the downside, it's all. All right, Ryanair down 1.2%. I would imagine that is because we're seeing a delayed negative reaction to EasyJet, which is yet to uncross.
There was news yesterday on Schneider. It might have come out actually in the afternoon. It's in talks to buy the remaining 35% stake in its Indian unit from the minority partner Temasek Holdings, the Singapore-based firm.
Okay.
Maybe back on the up on the back of that.
Yeah, quite possibly. Right.
Should we have a quick look at some of them? Sorry, I've slightly lost my internet. I wonder how EasyJet are doing and Ocado.
We think yet to uncross. Negative news on the farmers there then. GSK and AstraZeneca both down 1%. British American Tobacco down 90 basis points. That's had a really strong run. And then SSE, did you say SSE had a trading statement?
Yes, reiterates 26-27 adjusted EPS guidance of 1.75 to £2 was the headline I saw.
There we go. 1.75 to £2 in the quarter. Strong networks operational performance, renewables output.
By unfavourable
weather conditions. It's too hot. It's too hot for the hydro dams to work.
Correct.
That's up in my hometown.
I was going to say, that's your part of the world, Rick.
Yeah. Picklochry Dam we used to go there as kids, and they've got a salmon ladder, so the salmons can jump up over the dam. Yeah.
Oh, awesome.
It's very cool. But yeah, a stock with a trading statement to be up 27 basis points. You'd almost take that as a long-term holder, wouldn't you? Decent run SSE have had in recent times. Let's have a quick, oh dear, no, that's not going to work. What has SSE done? Yeah, lowest £15, even back in April. It's seen a 20% rally off the lows. Not bad. Right, Tom Roberts, what else you got for us? Is EasyJet open yet?
Looks like it. Yes, just opened. Andrew McKelvey was right. Doesn't look great. Down 6%, 495, 496. Coming off.
This thing is an eternal disappointment.
Hang on, down 31 pence, it looks like, from the close last night. Closed about 526 last night, didn't it?
Yeah, 6%. So
and it is 495 trading.
And it has traded around that £5 level since 2023. And it's, if you ask me to make a price in EasyJet, I reckon I could get it within 20 pence, because it is just, you know, £5.10 to £5.30, and that's where it's been. So, you know, is this a breakout lower?
Or is it an opportunity?
Or is it an opportunity? We saw opportunities this week already in Barrett. We saw opportunities in B&M. I know Andrew took advantage of that. I think he traded around it back down to 225 yesterday. But is this an opportunity? Down 7% now in EasyJet, or you know, are you flying for the exit?
Let's just have a quick look. Got my screen back up. On its lows now. 484 trading.
I think because it
looks
so
ugly,
easy
actually,
to be long this thing. Right, I could definitely be guilty of being long this.
And I was going to say, would you then try and pick a level here, viewers, of where you think is a buying opportunity? I'm not sure. It was now down 8%, actually, 483. It's just dropping, actually.
I would potentially take these into my ISA.
Would you?
But as I say, it's an eternal disappointment. I don't understand how they cannot be expanding the margins, and you know, we're considering what's happened, right?
But how much upside is there, even on a longer term trade, like putting it into your ISA or on a share dealing account, fully paid, locking it away?
I mean, this thing was 11 quid.
It's not going back to 11 quid, Rich.
I mean, Ryanair's all-time high. So why do Ryanair get it right and these guys continually get it wrong?
Management. Person at the top in charge.
Yeah.
Running a... I mean...
The difference between the two of them is absolutely startling. Look at that. That's Ryanair since COVID.
Can you put two charts up there and cross them in terms of Ryanair and EasyJet?
We'll do that for you for Fast Markets. We'll try and get that together.
That's a 5-year chart, isn't it, though, that one?
That's a five. That's COVID.
Yeah.
So why has Ryanair managed to climb through the clouds from 16 euros to 24, and EasyJet's gone from 12 quid to 480?
I like the clouds reference there. Very good question. Costs?
They're the same business,
but being run quite differently.
And one run out of Europe and one run out of the UK. But what an amazing opportunity as a fund manager for a long short. You know, that's the kind of decisions that make you...
make you a star in what you do.
Yeah.
But that is what, you know, that's the good pickers for the fund managers of what they do and how they do it.
So now are we going the other way? Now are we buying EasyJet and shorting Ryanair?
I don't comment on that. I just fly with those airlines. Is EasyJet a buy? I'm not sure, Rich, at the moment. I think there's better value out there.
I wish Michael O'Leary just ran all these aeroplanes. And the French ATC.
Whether you like him or not, he's doing a good job at Ryanair.
I've always said if the CEO of British Airways was sacked, chart off, thanks guys. CEO of British Airways was sacked, and Michael O'Leary was put as head of IAG, then the stock would be up 50% in a day.
And you'd see some buyers.
Yeah.
You would see some buyers.
It would honestly be, because airlines and autos, my goodness, how terrible investments have they been?
Awful.
Yeah. Anyway.
Let me take a quick look at Ocado as well. They had numbers out today.
Up 10%.
I was about to say 260 has just traded. That's
delivery.
A big move. Up 10%, viewers. Closed last night 235, opened at 256, trading 258. Had decent reporting this morning. Excuse me, I saw a flash headline. Maintains full year guidance, technology solutions, forward revenue forecast looks good. Just seeing if I've got any breakdown of the numbers there.
So EBITDA is 91.8 million in the first half, up from 52 in the previous corresponding period.
I'm pretty sure revenues are up as well, weren't they?
Revenue's up 13.2. That's interesting, because you felt at one stage like Ocado was in some serious trouble. I actually own some of the bonds and get a decent rate. I think I was getting 10%, 11% on the bonds.
Wow.
But you were watching the equity with a few worries. Let's see. There you go. Oh, it has been terrible. Whatever we say, there you go. I'd rather have been in the bonds.
That's not a pretty chart, actually.
No. Don't Marks and Spencer's own some of this? I know they've got a partnership, but I don't know if
they've got a stake as well. No, I don't think they do, actually.
No.
They're up small as well this morning.
Right, we'll take a quick look again at Rio's. There it is. Why? Honestly, sometimes I should just stick to what I know, and that is Rio Tinto, because look at this thing. As we managed to get in there on the open with iron ore up 1.2%, we've managed to get a couple of cheap Rios in there, as everybody else was getting excited about other stuff.
Trading at its highs now, 44.38 for the day.
I'll just stick to trading those. Forget shorting the S&P. Just trade iron ore and Rios. What else have we missed this morning? Swatch.
Yes.
What is the time, Mr. Wolf? It is up 3.6. So we looked at how dismal the chart was, and sometimes people like buying poor numbers, don't they? Because it's
142.85 up 4%. I've got here on the boards.
That's that's the B line, isn't it? Let's have a look at that one then.
Main line should be around about 142.80.
There we go. So what do you guys think? Who's let's do a little poll. Who owns a Swatch watch? What's your preferred watch? Is it a Swatch? Is it a Casio? Or are you one of those ones like, I bet your Monkey Man's got a Rolex? Bet he's got a whole arm of them.
Decathlon, 10 quid.
Decathlon?
Unbreakable though. Unbreakable.
I'm an Apple Watch man. Apple Watch, Casio, Swatch watch, or a fancy one.
Or a Luke Moore, Cartier, IWC,
does he?
Patek Philippe. He has a collection.
My history of watches, right? I bought a, what was the, Raymond Veal, right? Raymond Veal was like an introductory kind of into nice watches. I think it was £600. And we went to Dubai, and my girlfriend at the time wanted to go and buy a fake one. So I decided, right, I'll take off my real watch because I'll be trying on. So I took it off and put it in the hotel safe. Completely forgot it. Flew back to England.
Oh no!
And left it in there. Then I had a.
I hope they sent it back to you.
No, they didn't. No, couldn't find it.
Of course they couldn't.
And then I had my prized possession. What was it? It was beautiful. I bought it in South Africa. Bought it for about 3,500. Next thing, it was worth 8,000.
Wow.
I can't even remember the brand. And it got stolen in Miami.
You haven't got much luck here, have you?
That's what Apple Watch, and that's it.
And that's it.
Yeah.
I think we've got a few here. Tag here, Apple, Breitling, no watch. Fair enough.
I do have
Omega.
a Casio.
Do you?
Because James Bond has to have a Casio.
Does he?
Well, you cannot have a smartwatch if you're a spy.
Good
'Cause
point.
You can't.
Yes,
You can't.
Good point.
Can't have the Russians knowing where you are.
James Bond is linked to Omega, isn't he?
That's right. Yeah. Yeah.
Tag Heuer, one of the, I like Tag Heuer. Sort of 1990s classic.
It's a good one.
I like that.
Younger saying, "I am timeless."
Ah,
A Breitling. Yes, it was a Breitling. That's the one. I had a Breitling. Loved it with it.
Very
with
nice
aeroplane
watches.
connotations as well. And good morning, Natalia. Talking about Miami, our friend from Miami, tuning in there as well. Good morning to you. And good stuff. Right, it is 8:16. We've got an updated Guess the Chart, because this time the correct chart's going to have been put in, isn't it, producer Phil?
we are not guilty.
He's not happy. And he made me a lovely cup of tea this morning as well.
Just as we're talking, Swatch has moved up another 1%, so now up 5%, trading 144. So, good highlight by Rich this morning. Worth keeping an eye on that throughout the day, though. Just keep an eye on that. 5.2% it's trading.
But they do own other brands, don't they?
They do. You're right.
I think they own quite a fancy one of the ones that we've spoken about. So it's not just those like funny, colourful watches. They also own Omega.
Got you.
Of Bond, Longines, Rado, Tissot, and obviously the Flick Flacks. Very cool.
So, Rich, Swatch misses its half-year results, misses expectations, says it's hit by a weaker demand in China. It was being cooled down full 4% in pre-market, sales down 7%, and now it's up 5.2%.
I think it's one of those ones when you buy the third. Is this a third warning, maybe? So.
Oh, good point. Okay.
So you profit warning number 1, if it's a surprise, you sell. Profit warning 2, you do nothing, and then profit warning 3, pick them back up.
So it's down 17% year to date, but before the open this morning.
And then what's something like our friend from South Africa, the Swiss watch company? Got my brain this morning. Too much dancing last night with the team.
South African watch company?
There's the Swiss, but it's listed in South Africa as well. One of the biggest watch companies in the world. What's the one I'm looking for? It's the guys, biggest watch company in the world listed. Come on. Yeah, what's the biggest watch company in the world that trades? The Swatch Group, producer Phil. Johann Rupert runs it. We're not moving on until somebody tells me what the Swiss Watch Group. It's the biggest one in the world. Richemont.
Richemont. Okay.
God, it's even got my name in the title.
Sorry.
Richemont.
I was struggling there, Rich.
What's that for the year? So Swatch is down 70%. Richemont, I think, is up. About 15.
And Swatch down 17 year to date.
Yeah. So
another good pairs trade.
So the posh watches, we're seeing Ryanair, massive.
Ryanair, EasyJet, Swatch, Richemont. just on Richard's comment as well regarding what Swatch have in them in terms of their group, Longines they own as well. So Longines, Omega, Tissot, all part of the Swatch group. So yeah, let's keep an eye on that.
Is this a look at the consumer as a whole? Because if you're buying a Richemont watch, right, you've got to be earning over 100 at least. If you're buying a Swatch watch, you can be buying it for your kids.
Correct.
Right? Or you can be earning 50 to 80 and you can, want a nice watch.
Yep. The aspiration.
So it's very much two ends of the scale. Watches of Switzerland is more Richemont, whereas is the high-end working class, low-end middle class starting to struggle?
Good question.
I'm not sure EasyJet and Ryanair is the same kind of story.
No. Compared to Emirates and other high-branded airlines.
Good. Right. So who wears what then? Smartwatches are 51%. I'm amazed that Richemont's not been hit more by the smartwatch phenomenon. And then we've got Rolex and other luxuries, 31% of our viewers. Ooh, look at you. You've all been investing well, haven't you?
17% with James Bond.
17. Those Casios are just absolutely classic, and they still cost, what, £22?
Great watches.
So they are.
Swatch zero.
Nobody owns a Swatch.
Nobody owns a single Swatch.
Not buying that one then, are we?
I was going to say that wasn't.
Shall we short it on the 4% rally?
That doesn't indicate well at the moment.
But at least, look at just one last look at Richemont over time, right? Again, from COVID, this thing has been absolutely stellar. As a real luxury company, considering that Louis Vuitton and Gucci have all topped in 2023 and then collapsed, this thing, kept going. So yeah, good. Right, it is 8:22 in the morning, and we're going to go for a very quick 1-minute break with a proper guess the chart. What is it? It's a US stock. Let's go.
Hey trader friends, welcome back to Fast Markets with myself and Tom. Hey Tom, long time no see.
Good morning, Ange.
Good morning to you.
How are you?
I'm very good. I've been thinking about you because the weather's been good, so no doubt you've been out on the, cricket grounds and
Doing bits and bobs with the children,
Fantastic.
trying to keep them active,
Yeah,
keep them
yeah.
out of mischief,
away from the screens.
away from the screens. Bit of cricket, bit of golf, trying to do everything.
Have you been to cricket? Because it's looking a bit like the markets this morning.
The cricket I did go to last week as proud sponsors. We managed to go and have a quick look at the Lord's Test, which was good.
Yeah, that's right. And
yep.
this weekend it's the women's.
It is on
Yeah.
Saturday. Should be a great day out as well.
Should be a good one. So just let's have a quick look at some of the ones that you haven't yet covered, because I was listening intently and putting this also on the chat. Asa Abloy, just checking on that one. This is a really key one, trader friends. If you're watching for a heads up into the next 6 months, everyone needs locks, right? You got lots of locks in your house. Look at that chart.
Probably not enough.
Or are you one of those where you've got one of those systems that triggers an alarm no matter which room you go to, and it's got lights that come on automatically?
Not at all.
So take a look at this chart, trader friends. Look at that move. This is 5 minutes just to show you that. And what's been happening here is Asa Abloy. This is the lot maker. Its profits fell less than expected. Now, what this tells us is despite all that uncertainty, right? All that tariff madness that we're seeing out there, all the concerns surrounding building, and also don't forget we need locks for big infrastructure like factories, and the fact that they also sell electromechanical solutions as well. They're now saying they see a growth in the aftermarket due to strong demand for these upgrades in electromechanical products in its lock division.
So worth keeping an eye on that, indeed.
Yeah.
And trading up this morning.
Yep.
It's nearly 7% now.
Yeah, totally. On the way down, Wise.
Wise.
Yes.
Numbers this morning. Excuse me, Ange. They had their Q1 trading update. Looked like underlying income was up. Revenue came in at 214 million. Active customers, there is some growth there, but they said their underlying income does actually miss estimates as well. And sorry, I'm just trying to bring up their price now. They were down about 7%. Actually, they're down 8% now, trading 10.41.
Yeah. I mean, this is a really interesting space because they're trying to break into all manner of, multi-currency products as well. You got a lot of clients that trade Wise. Is this one that is starting to become more interesting for your clients?
It's one that people keep an eye on. Obviously, payment solutions, currency solutions. Its active customer base is growing year on year. They have stated that. But then it comes down to their revenues as well. So their active customers are growing, but is their revenue going to keep up to forward guidance? At the moment, it looks probably not likely, hence the drop down this morning. People are interested in the payments area and sector and foreign exchange sector as well. So we get a bit of business in this as well.
Cool. So trader friends, those of you that like trading the space, Wise is huge. It's so huge in Southeast Asia. I almost don't have a friend there that doesn't use Wise.
Yeah.
It's almost like they're beating Revolut's ass over there. That's how big they are. And everyone that now, hooks their parents up or their grandparents up with a card, it's got to be Wise.
It's going to be a Wise one.
Yeah. It's really fascinating.
Yeah.
The other thing that has gained traction this morning, HelloFresh. Are you a fan of HelloFresh? Let's have a look.
It's not one that I know that well.
So HelloFresh, taking a look at the stock here, up more than 4% as we speak. They're the ones that deliver.
Yeah, they deliver the box of food or groceries,
Yes.
and you make your specialised meals.
Yes, that's right.
from
So
that.
you do know HelloFresh.
Oh, I know HelloFresh. It's not a stock I know that well.
Ah,
Trades out of Germany, I know. Trades
Yeah.
about €8, give or take. But
that's right. It's
it's
got that
not
little...
one I see any business in from a desk point of view.
Yeah, what's interesting though, those of you that like charts as I do, and Axel as well on the show, it is starting to have this swoosh uptick. So this is the 5-minute chart here, trader friends, but let's have a look at the hourly chart as well. Also taking a look at the daily chart, moving that further out. Now, this has been a stock that has been in pain for a long time. It was one of the darlings, right, of COVID, of lockdown, much like the Pelotons, much like the, right? Everyone went to like super delivery. We're going to buy those crazy, I'm sure. Monkey Man has bought like those expensive, like, oh, £20 for a Malbec, that's okay during COVID, right? But then they soon lost its luster. So have a look at the chart there. You can see on the left-hand side.
Where's the high, Ange, on this? Where on the left-hand
The
side?
high was 14th of September 2023, thereabouts. And it was around 34.
Yeah.
So very far, it slid from its glory of, 34 euros down to 8 there. It is starting to stabilize and move slightly higher. It has to be said with not a huge amount of conviction, but it has started to find a floor.
Yeah.
Yeah. Nowhere near to those heady highs, but it's starting to stabilize at around that €8 mark. What's also interesting about HelloFresh is that it's starting to hook up with lots and lots of other meal providers to try and diversify its meal kits. I've never ever bought into these meal kits because, quite frankly, that box will last us approximately 1 day.
Correct. And 2 teenage boys would devour it.
Everything.
But also,
Everything. In the fridge. Right, let's have a look at Siemens. Moving over to Germany right now. Siemens AG moving higher, 3.6% there.
Yep. Trading 225 euros out of Germany at the moment. Good move up there.
And it is
Obviously,
on track.
fairly popular stock with IG clients as well. One of the main listings, if not the main listing in Germany. And starting to move a little bit.
Yeah.
Though I haven't seen any fresh news out today. I might be
No,
wrong.
I think this is a culmination of some of the good news that it's had recently. It had a share buyback not too long ago. Also, it's had news about more expansion due to the Munich train factory. Phil is in my ear right now. Monkey Man saying Malbec is a nice wine on the chat. However, Monkey Man, were you one of those? Own up, that paid like 20 quid or 30 quid, in the days of lockdown for a bottle of wine that is obviously not worth that much. But I think we were a bit crazy. I seem to recall...
As HelloFresh saw.
Yes, as HelloFresh saw. Right, Maturin saying Andrew McKilvey, small stake in this. Maturin, binary, just putting up the chat there so that we can all see it. Steve Davies also chiming in there. Morning, Steve. Riot Blockchain. Let's have a look at. We will have a look at that when we've got all sessions coming up. But let's just have a quick look at the commodity space, because I don't think we've done that this morning.
Sure.
We're seeing gold starting to still stay at that level, 3,329 bucks an ounce there. Silver also having a look there.
3,785 on silver, down about 0.2.
Yeah.
Gold just down 0.5, as you said, 33.29. Oil a little bit weaker this morning as well, by about 20 basis points.
Yeah. Platinum also coming off. Platinum down 2/3% there, but that's probably quite normal, quite expected, because it had that huge bounce in the last session.
Yep.
Some 4% and about 17% above the 50-day moving average. Right, we've got to love you and leave you, Tom, and let you get back to your very busy day. Thank you for your precious time with us.
No, it's been great this morning. Thanks to you and Rich. Always good to be here.
I'm glad no one asked me what watch I own. There was
The Decathlon, that's all you need.
the indestructible one.
£10 unbreakable watch.
I wonder what watch Issa wears, because Issa is coming up with me next.
It'd be something good.
It'd be something good, right?
Yeah.
He's very silly, cerebral, so I'm expecting something good. Right, we've got Issa coming up next. Tom, we'll see you on the floor. And
Thank you very
those
much.
of you go and grab your coffee. We'll be right back.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, the fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Okay guys, before I teach you how to use this, I have to teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready. Time to go. Hey, come on, Pat, come on. Cash returns, come on. Oi! Well, you're not going to get better than cash returns.
Hey, trader friends, welcome back. And we have Issa back on the show. Hello, good morning to you, Issa.
Hi, yeah, how are you? I'm good. I've not done psychology and trading in a while.
I know, we've missed you. Everyone's been, wondering what's happened. Has he gone on his beach holiday and not come back?
No, I've just been really busy, so it's been very difficult to make time. But no, I'm delighted to be here now. Delighted to be here now.
Fantastic. And as you're on, we have a great unveil right now. So
this is for the chart?
Yeah, we had guessed the chart earlier on, and the chart was Warner Brothers. And we have a winner. Some people guessed Riot Blockchain, others guessed, I can't believe you said Jesse 14 NVIDIA, but I loved it. Well done, Two Phones, because Two Phones managed to get the answer first, Warner Brothers there. Right, so Issa, we have a huge favor to ask you. As we're on the cusp of the earnings season as well, I'm just showing my chart here, showing all the huge earnings coming up in the coming month.
Netflix?
Yeah, Netflix. I knew you were going to say that. I've also done a short on Netflix for those of you who want to see the preview on the YouTube channel. And Axel Rudolph has also done an exclusive written preview with analyst views and everything on the IG platform. So you can find that there as well. But this is a really good time, Ezra, to talk about active versus passive investing.
Yeah, that's kind of the topic I wanted to talk about today. In part for a couple of reasons. Number one, we're seeing this massive flow of passive investment, and I think it's worth recapping what are some of the benefits of that. But then I also want to talk a little bit about what does that maybe mean for market dynamics and for active traders, and what are some of the psychology effects that are kind of going on with that. So I guess as a recap, and what are some of the benefits of passive relative to other forms of investing or trading?
Yeah, and a lot of our trader friends as well wanting to understand, do you use different hacks if you're, dollar averaging in, for example, for a longer term play? I know you're a regime trader. Talk us through the differences.
Well, I think when you're thinking about index investing, the three main benefits are people tend to sometimes feel like they have kind of overconfidence in their ability to pick stocks. And so the reality is that by doing an index, you're kind of buying a diversified portfolio. That's the idea, at least. It's very low fees compared to kind of other forms of investing. And so like ultimately, if you're generally a long-term buy and hold investor, then it makes a lot of sense to maybe be thinking about some of the main kind of ETF style products. I think if you're looking at different time horizons, or like you say, I think if you've got strong hypotheses about kind of medium-term trends or shorter-term movements, then it maybe makes sense to do kind of a portion of your portfolio as passive, but then also a portion of your portfolio either active, longer term holds, or a kind of more active trading, shorter time horizon activity.
Yeah. And so whilst you were talking, I've pulled up, some of the Vanguard FTSE ETFs offering. There's a huge amount here. I was with some mates yesterday, catching up with them, and they were looking very pleased with themselves because all of them had FTSE trackers.
Yeah. Which is doing very well.
I know, right? I mean, I can't believe we're in this space talking about this, but it's very easy to navigate on our site. I mean, if you want to also just search, for the entire universe of ETFs on the IG platform, you just simply type ETF as well. Don't forget that we have a wide range, everything from thematic to active to passive ETFs as well. And one of the key points, I guess, from this space is to just keep an eye on the cost of these ETFs because, they vary greatly, right?
Yeah, I think the cost varies a lot. I think the other thing is a lot of people look at ETFs and they assume that all these ETFs are kind of essentially the same. And the reality is that actually some of these are quite actively managed actually, and their holdings are very different from what you would expect from kind of a standard S&P 500, for example. I guess the reason I wanted to have this conversation, honestly, is because I kind of weirdly read a paper. It was a paper from LSE, and I'll send it to you, Ange. Maybe we can share it in the chat.
Yeah, definitely.
But I think the paper started talking about a few things. It started talking about, number one, what does passive look like as a share of the market? And so when you actually look at passive plus active combined, the original paper came out about 6 years ago, and it was at that point in time where it had crossed the 50% threshold, where more than half of the active and passive total combined funds were actually passive. And about a couple of months ago, it actually now has passed the 60% threshold. So we now know that more than 60% of total active plus passive funds are actually passive. So the share of passive has just been like rapidly increasing over time. And I think part of that is because now there's kind of this received wisdom that you should be dollar cost averaging. I think part of it is also the performance of some of the kind of passive indices, in particular with kind of Mag 7 doing extremely well, showing really, really strong performance. And I just wanted to talk a little bit about like, what are some of the dynamics in a world where actually more than half of the funds that are going into the market are actually coming from passive sources? Are you surprised to hear that it's 60%? I think when I saw the number, I was really surprised.
No, I'm not surprised at all because, I've been in this space for, I'm not going to show my age, but for a very, very long time. And the one trend I've been seeing is that, especially in Europe, it feels like investors are, for whatever reason, and there are many good reasons, and I'd like to think that people here have more of an appreciation for work-life balance. The consistent trend is, investors are becoming sort of not lazier, but wanting the control and not having to pay the high fees that you get with a really active fund manager, but they want the exposure, right? So we've been seeing an increasing demand in the passive and also the ETF space. One key figure I saw that I read recently that was amazing was that the ETF space in the US is like something crazy, like
huge, right?
13 billion or whatever, and Europe is not even there yet, and it's growing, right? It's growing every single day. And in the next year alone for ETFs in Europe, we could see a 13% growth just in the next year.
Wow,
so
that's crazy.
I think there is a growing demand for this space. I'm not that surprised.
Yeah, it's interesting. So this paper from the LSE, a super interesting paper, basically walks through what does the world look like as that passive number starts to get higher and higher and higher, and basically identifies kind of two main things that we should be aware of. The first is that as the share of passive increases, the side effect of that is that for essentially the concentration of assets largely accrues to a very small number of companies, in part because the vast majority of passive flows are going to kind of cap weighted indices. And so then you kind of continue to see, in the same way that the Mag 7 is now more than 30% of the S&P 500, that might get even more extreme over time as more and more of those flows are kind of going towards indices, and in particular indices that are weighted towards some of those kind of mega cap companies. And actually, participation or not participation in indices makes a huge difference then for kind of the amount of the amount of volume and the amount of liquidity in most of the equities. So I think that's trend number one. And trend number two, which I thought was even more interesting, is actually as the share of passive gets higher, the amount of volatility that can be driven by the active segment actually gets really magnified. And so then it leads to a lot more sensitivity in the market, at least on a very short-term basis, where kind of you don't have that much price discovery. And so then there's a risk that some of the moves that you'll have are actually even more volatile than they would be in a world that is a bit more kind of actively driven, where different investors have different strategies and are taking different views on what prices should be. And so that's kind of leading to a kind of more effective clearing. And that actually has some psychology. Yeah.
Are viewers loving all those very, very interesting anecdotes discerning? And Mara chiming in saying index funds are very efficient, highly diversified with low cost charges. What do you think?
I agree with all of those things.
Yeah.
Yeah, I think I agree with all of those things. I do think, so there's three psychology things that I wanted to kind of talk about, and I think they relate to some of the stuff that's being said in the chat, because I think that received wisdom is 100% correct, and it's the results have borne out those kind of differences over time, especially over the last kind of 5 to 10 years. The three kind of psychology phenomena is like, number one, we're now in a world where passive is seen as kind of received wisdom. And while that is inevitably a strategy that has made lots of money, it can lead to herding effects and it can lead to the slightly limited price discovery. So it's something to be a bit careful about, in particular, in an environment where, like we said, there might be kind of heightened volatility. I think the second is that passive gives the impression of diversification, which is to some extent true, but actually the market concentration of some of these indices is extremely high. So like we were saying, the Mag 7 make up more than 30% of the S&P 500. And so actually, if you're buying an S&P 500 ETF like SPY or one of these, you're largely, a third of that money is going to very, very small number of companies, and more than a third of it is going to less than 10 companies. And actually, even if you buy some of the kind of global cap weighted indices, you're still essentially buying the US market, because the US market has outperformed so much versus the rest of the world. And so one thing to be careful of is often investors and traders will use ETFs as a kind of view to give themselves diversification.
Yeah, but in essence, they're not, right?
Careful.
Yeah.
Yeah, you should be really careful about how much true diversification are you getting. And actually, like, so personally, one of the things I've been looking at a lot is equal weighted indices, because I maybe don't want as much market concentration in some of those big names. And so
Nice.
it's really important to think about what's real diversification and what is diversification you kind of are telling yourself is real, and then
Yeah.
giving yourselves potentially a kind of misaligned sense of security.
Yeah,
And then the
totally.
third thing that I think is really important is when you think about passives, people often just look at the performance of the index and they compare that with the performance of either them personally or hedge funds or kind of portfolio managers. Actually, the reality is if you look at the average investor, and you look at their performance against an index, actually, even passive investors tend to underperform the index due to behavioral return gaps. So, what is essentially happening is during periods of drawdown, people who are ETF investors tend to get a bit scared and tend to pull money off the table. And well, actually, that's exactly what's going to erode your returns relative to the index itself. And so then you have to kind of think about two things, which is number one, as a ETF holder, do you feel emotionally balanced enough and stable enough, and do you have a longer term perspective and a degree of patience enough to withstand some of those drawdown periods? And then secondly, are you comfortable with the fact that even if you can withstand some of those drawdown periods, are you comfortable that other ETF holders can as well? Because otherwise, in a world where, like we were saying, passive might make a higher and higher share, you're more likely to see some of those herding effects that we spoke about earlier. And that's where you can get quite sharp corrections or sharp kind of returns back to strength, the kind of aggressive V-shaped moves that we've had recently. A lot of that is a function of the fact that there are some of these behavioral gaps amongst investors.
I really like the fact that you talked about, being very careful when you're trying to diversify and not looking closely enough into the ETF, because that's easily done, right? And you think that,
Of course, yeah.
A load of our clients also ask us about that, waiting and having a look to make sure that you understand that term that we use here and at Tasty a lot, the correlation and assets that are not correlated. So
Yeah.
you're probably
Well,
going to
so
say this is...
especially
Sorry, go on.
I was just going to say, especially if you have, for example, an ETF portfolio that you think is your diversification, and then your individual stock names you own, for example, Nvidia or Tesla or names like that.
Yeah.
Actually, you're kind of double owning a bunch of those names.
Exactly.
Which is fine, but you should be careful about what your net exposure is.
Yeah. So you'll probably laugh at me and say, that's crazy, Ange. But this is how I approach my passive investing. I make sure that they're so far away from the usual Mag 7s and as you know, I'm heavily invested in the Mag 7s, and they're not anywhere close to the US indices at all. So one example is I've recently put money in the Sprott junior uranium miners, and this is I'm dollar averaging in, because it it can be volatile. This is a longer term play. This is based on the theory, trader friends, that everyone out there, especially in the US, they have this view that climate change, tech will solve everything. Tech will solve everything. Actually, it will not solve everything. So my base theory is tech will not solve everything. We do not have, as a world, the ability to go full EV for everyone, or full solar, or full wind turbines. Therefore, the only option is nuclear. And we're going to need a good base level of nuclear energy. We're going to have to try and solve that problem somehow of keeping, the waste safe and everything, but that is the only option. So I'm dollar averaging in, and I have these thematic ETFs because, looking at what it holds in it, there's never going to be an Nvidia, right? There's never going to be a Palantir. There's not going to be, right? So it's completely different to, for example, an S&P.
So it feels like kind of genuine diversification.
Exactly, exactly. Similar to, gold miner ETF, or, if I take a look at the NATO ETF as well, that's another one. So I make sure I know the constituents, what is exactly in there, and I haven't just bought it.
No, I think it's really important. Actually, one of the things that I really like is if you have the IG Invest mobile app and you go to an ETF, actually directly in the app in the front page, you can see all the holdings and what share they have. And I often find that really helpful, in particular when I'm looking for, if you look at a lot of the global ETFs, whether those are global equities or global bonds, it's often the word global is deceptive because when you look at the US share, it's often more than 30%, sometimes even more than 50%. I know, for example, some of the global bond indices and ETFs have like half of their holdings are US treasuries. And so I think just being a bit careful about what ETF holdings are is really important.
Yeah. And you know about the weirdness about the naming convention as well, right, Issa? I asked a load of fund manager friends who, bring new funds to market, and I said, why did you make it more memorable? Why didn't you make it, the ISAR Kick-Ass ETF Fund or the AND AAA Fund? And the reason why they can't, even if they want to, is because they have to get those search words in. So if it's an emerging markets fund, they know that if they don't put it in, it doesn't get picked up, by other funds looking for emerging market diversification.
It's like a kind of bad SEO.
Exactly.
Yeah.
So you get the funds of funds searching for your type of fund. And therefore, that's why their names tend to be very long, because it's an SEO thing.
That's interesting. Good insight right at the end.
Shrimp Fred coming online saying data centers are ideal customers for nuclear baseload. Yes, that's right. And that also plays to my data center linked investment play. Arsac saying silly question. Arsac, there are no silly questions, right? Issa? No silly questions here.
None.
The move in ETF is based on movement of holdings, or at least she thought so, or demand supply of the ETF.
So as more people buy the ETF, the company that runs the ETF then buys the relevant amount of stock to kind of maintain their holdings to be in line with their own kind of assets. So essentially, if more people invest in SPY, the people who run SPY then buy more kind of shares in the market.
Right. We have to wrap very quickly, but another hot tip for you guys with ETFs, if you're moving a huge amount, and I know many of you are big players that are into ETFs, the rule of thumb, Issa, I don't know whether you know this, is that you try and time it so that it's smack bang in the middle of the European Open and the US Open, so you don't have like crazy volatility, right? You try.
Yeah. You often have like the rebalancing right before close or after open.
Exactly. Right, and we have to leave it there. Thank you so much. It's so good to have you back again. I'm sure Phil will be, coming by to say, can we have extra Issa to make up for lost time?
Well, thank you, Angie. Take care.
All right, we'll catch you later on the floor. And for those of you, stay where you are because we have a special treat, a new guest for you. Garth is coming on with Rich, so stay right there.
Today we're here because we've recently launched our Save Our Stock Market campaign. We just want to raise awareness for terrible cash returns that everyone is getting with their money just sat in cash ISAs. What we want to do is raise awareness for the great returns that you can get on UK stocks and help revive the UK stock market and get people investing.
There's a lot of bad feeling about the UK stock market, and it's really negating people's view on the UK market as a whole. There's some great companies. If we just start the ball rolling on people getting behind the UK stock market, then we can start to get the interest. And it's days like this, we get awareness of all the crowds talking about stocks. It's really that awareness, and ideally we'd like to take it to the government. We would like cash ISAs to be reduced, not because we don't believe in the chance of people saving, but more that you get higher returns, as much as 7 times historically in investing that you can from cash. And that's not saying people go out and take a load of risk. It's about education, and it's about helping people to understand the benefits of investing and the limitations of holding their money in cash.
Hey, trader friends, welcome back to All Sessions with myself. I am just hearing some voices, so maybe Garth is coming up soon, but we have so much to get you through at the moment. Just a quick overview of where we are on the markets before we head into all sessions, which is just opening as we speak. Looking like a pretty risk-on day at the moment. The FTSE is still near that 9,000 mark, but the US 500, US tech, just going slowly into positive territory. Let's have a look at where we are sitting in terms of all sessions there. And making the clicks there so that it starts evening out. Right, we have Taiwan Semiconductor Manufacturing up 4.5% there. We also have Virgin Galactic, all sessions up 6%. Some of the names in the consumer space, Best Buy, and also we have, taking a look down further, the NEOs as well, EVs heading higher. NVIDIA is up 0.6% as well. Checking across to the losers list, we've got United Airlines down more than 2%. ASML also down almost 2% there. As you heard Tom and Rich speak about this earlier on. Tell us which side of the fence you sit on a longer term horizon. Are you a fan of ASML, or do you think they are looking a bit challenged at the moment? Airbnb, I personally do not like the business model, so I do not have a position in the stock. Airbnb down 1% there. Delta Airlines following United lower. Novo Nordisk's, they're also down 0.5%. Just want to check in on Netflix for you because, of course, Netflix is the one that we are waiting on its results. How many of you out there still subscribe to Netflix? I am no longer subscribed because I was very cross with them upping my subscription so quickly, so fast after I was quite a slow adopter. But Netflix, all sessions here, currently up almost 0.5%. Now, there are two key things that you need, trader friends, to look out for Netflix. Number one is the ad suites or the ad growth number. The reason why this is important is because this is a next revenue generation cash cow for Netflix. Those of you that trade the stock, it's all about putting advertising using AI into the bits of the movies. I've even been told they can even float it in and float it out so that it's quite subliminal, so you don't know that someone's actually marketing that expensive Malbec to you, but it's within that film you're watching. And so all of this will essentially be the next ad cash cow for Netflix. Not just about you paying so that you don't get interrupted by ads, but these are smart ads that are implanted within the films so that it doesn't annoy you as much, but it still allows advertisers to get to you. The second thing is they're hoping that advertisers will want this because they have tech that I've yet to test that enable them to measure and to see whether producer Phil and Richie Rich, whilst eating their lasagna in front of the television, have clicked, or your eyeballs are looking at certain places where they have product placement. Kieran McKinsey, good morning to you. Also coming on board, talking about Netflix. If they do that, I will cancel Netflix. Yes, how much are you paying? I know Richie Rich is paying $12.99. Let's have a look as well at the chart here because the magic number is $11 billion, trader friends. So the company, in terms of an estimate consensus that many in the market are looking at, Q2 revenues 11 billion. If it beats, it's likely to make this price action head higher. Good morning, Kieran, as well. So let's have a look elsewhere on the all sessions because I have a feeling that they would have shaken out a bit more now. And just looking ahead as well, we've got GE Aerospace up more than 1%. Upstart up almost 1%. That's a very volatile one. And Qualcomm up 0.3% as well. Taking a look at the losers list, we've got Starbucks now marching higher in the losers circle. It's down almost 2% there. Yeah, ASML coming off a bit now, still down 1.7%. but coming off a bit more now. Now, we had, every time you ask, I listen. Shrimp Fred, I see you. You asked if I could try and bring on an airline analyst. This I can. I will put my feelers out because I have some very good friends who are still in the business. Some of them, the top analysts in aviation airline stocks in Europe. But also, we had a request from some of you asking me for the top upgrades and downgrades. I'm still working on, I've now managed to get the AI to scrape it for me, but now I am trying to train it to put it into a nice infographic for you. So some of the good ones that it scraped this morning, if you come off my chart whilst I try and get that on, we have Lululemon. Let's have a look at Lululemon, which is all sessions. It is currently up 0.25% there. Just bear in mind though, Lululemon had a target price cut by HSBC and they've lowered it to $275 from 360. A bit late to the game that, but you know, still that is HSBC. Taking a look at Nike as well, because Nike is also all sessions, one of Rich's favorites, down 0.25% as we speak on all sessions. Nike also had a broker action this morning, HSBC raising their target price there to 88 from 80. And then for some of those, let me see, I also have a scrape going on for those that are not all sessions. Let's see if there's, oh, it came up with a really strange one. I've not traded this one before, it has to be fair. And it's not on our system, Quaker Horton. If any of you know what this does, it had a target price upgrade by RBC to 150 from 134. Right, Shrimp Fred as well. Do we have a quick moment to let Shrimp Fred know about something that I was trying to find out for him? Have I got time, Producer Phil? Yes, I can hear you. We're having a bit of a connection issue today, Shrimp Fred. So when I was talking to Issa earlier on, I couldn't catch every third word, but we managed to make it work. But I was going to answer a question that you asked me about short interest, and you asked me where I found it, and many of you viewers then said to me, hey Ange, but what if we don't have that subscription to Bloomberg and to Reuters? Well, if you go to Yahoo Finance, Shrimp Fred, and you type in any instrument, so for example, Tesla, if you go down, you'll find short interest at the bottom there. So you too can do this at home for free. Right, we're gonna have to leave it there because we have a special guest that's coming up next. I'll try and put that in the chat for you as well, Shrimp Fred. But we've got Garth McKinsey coming up next with Rich, so stay where you are.
Okay guys, before I teach you how to use this, I have to teach you how to use this, the mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready, time to go. Hey, come on Pat, come on. Cash returns, come on. Oi! Oh, you're not going to get better than cash returns.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
This is a huge moment for IG and a major milestone in the UK's crypto journey, with retail investors now able to buy, sell and hold 35 crypto assets with a grown-up business. Adoption is rapidly growing, and with UK crypto regulation gathering steam, we want to give existing and future investors a platform where they can trade crypto with clear and transparent fees with a provider already used by hundreds of thousands of retail investors. With the addition of crypto, our customers will enjoy a more streamlined investing experience, with IG now providing a one-stop shop for a wide range of assets. We're really excited to bring this crypto offer to the market.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Okay guys, before I teach you how to use this, I have to teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready? Time to go. Hey, come on, Pat, come on. Cash returns, come on. Oi! Oh, you're not going to get better than cash returns.
Welcome back to Trade Live with IG and Garth McKenzie joining us. How are you, sir?
Hello, Rich. It's very good to be here. Good to see you.
It's fantastic to have you in at last. It's taken me forever to plan it.
Yeah.
But at last, some of you may have heard Talking with Traders podcast, and you're now on episode 100 and...
We've done about 130 episodes over the last 5 years since we started in 2020. So it's been a good run.
So what we're going to do, we're going to talk about markets. We're going to talk about the indices, the currencies. We're actually going to take a quick look at South Africa as well, because some of you may have guessed from Garth's accent. That is where he's from originally. And then we'll take a quick break, and in the second half we'll go into what lessons do you learn from speaking in depth to 130 traders, which is going to be of real interest.
Oh. Yeah.
So, yeah, right. What do you think of markets right now, here where they are?
Well, we're in that sort of northern hemisphere summertime, right? Which I know through my career has always been. I've often thought July and August is kind of a good time to go to the beach and take a break. And it does feel like we're in that sort of environment at the moment where it's a little bit choppy. There's a lot of uncertainty. The risks are still mounting, as we know. There's tariffs, a lot of tariffs going into effect on 1 August, which the market's still sort of looking. I think some of the market participants are looking and thinking, is he going to tackle or not? And it doesn't look like he is. So there's that.
Well, it's certainly priced for him not.
Yeah, exactly.
Basically, don't believe anything he says will ever happen. And that's the way the market's priced.
Yeah, but that's the risk, I think. And I think that's the risk, that what if he doesn't? What if this time he actually really is serious? So there's that. We're obviously into second quarter earnings season in the US now. a lot of the expectations have been dialed back quite a bit. So the bar is actually set pretty low for earnings this season.
I think
however,
260. Let's have a look at our updated forecast there. $263 of earnings for 2025, and then going up to 294 for 2026. So that does put us on, that's 24 times this year.
Yeah, it's punchy.
Yeah,
it's pretty punchy. But having said that, these earnings figures have been dialed back quite a bit for the second quarter now. And what we've noticed, look, it's very early. This is the first week really of the earnings season, which is going to run for the next month. But what we've noticed so far is that companies that seem to be coming in line are getting sold. We saw it with JP Morgan to some extent. It was down a little bit, not big, but then you saw ASML yesterday, for example, got whacked very hard on what numbers that actually were not bad numbers, actually.
So if you're not giving guidance, you're in real trouble.
Well, that's it. I think the point is the bar's now being set low, but if you only meet the bar, the low bar, the market's kind of saying, well, that's not really good enough, because you've been primed for the potential to beat. And if companies are not beating on a low bar, well, then what's that telling you?
Especially when we've got 13% of earnings growth already in the price for next year.
Yeah, exactly. So these markets are, the US market specifically, not cheap. We know that. It's not cheap, priced for good growth. And if you're not getting that, well, that's the risk. So as I was saying earlier, the risks are still mounting. But having said that, broadly speaking, we're still seeing a bid in the market. You saw yesterday, S&P 500 traded down to 6,200 briefly on the threats of Trump wanting to fire Jerome Powell. Yeah. And it was bought. Look, obviously he walked back those threats quite quickly, but you could see that the bid came into the market. So it is still this choppy, uncertain environment that I mentioned. But the risks are mounting.
And you are starting to look for alternatives, aren't you? Where can you find exposure to tech that isn't necessarily the Mag 7?
Yeah, well, that's it. And there's lots of other interesting places to be looking at. And I love looking at the themes out there, different themes that are growing. For example, drones is a big one now. We've got things like Archer Aviation and Joby. These are companies that are on fire at the moment, taking off. Excuse the pun, but these are themes that are quite exciting at the moment. So you can look outside of the Mag 7, and there are plenty of opportunities. But also you can look outside the US as well.
Yeah,
there's plenty outside the US, which also looks attractive.
And so we've got a chart of KWeb up here. Now tell us a bit about KWeb.
Well, let me bring it up and get to that chart that I've got. Let's just run through these. There we go. That's the one. That's KWeb. So KWeb is the CraneShares China Internet ETF. And I guess the name says it all, right? China Internet.
Yeah.
But what gets me interested is the fact that the price is now starting to actually break out through some technical resistance there. If you have a look, the $35 is the resistance area on that chart, which is where the price has bumped up against that over the last 2 months a couple of times. But this week, we've actually had a big gap out through that resistance, and you can see it happened on quite big volume as well, which is always a good sign when you get volume confirming a breakout like that. And that is an ascending triangle pattern in technical analysis terms. And the bullish breakout to the top is, well, it's good news. It should see this price have a run at that previous peak in March. So to me, this looks good.
10% from here?
Yeah, potentially another 10% to get to that peak in March. But if you were to zoom out on this chart and look even further, it's actually made a beautiful big base over the last 2 or 3 years. And it looks like it's starting to build out the right side of a base. Okay. So, I think on a more medium-term view, this looks good. It's something I own in my portfolios, and I'd potentially be looking to add to it now that we've seen this breakout above $35. Yeah.
Yeah. Let's just take the one on my screen is in pounds. That's why it's a different price. But we can see from 2022 what it's done there. So taking you right back to when obviously the 2021 kind of fallout.
Yeah.
But this thing, as you say, it has really stabilized between that 20 to 25 sterling.
Yeah.
Yeah, it's potentially primed and ready.
You see, I like a big base like that. You know, I love a cliche, the sayings, but they always say the bigger the base, the higher into space, and that's what we've got here, right? We've got an enormous base that has formed over the last couple of years there, and it's beginning to build out of that. You can also say that that's a stage 1 base in technical terms, and now you're starting to see the price build out of the right-hand side there. That becomes a stage 2 bull market, and that's to me looking like where we're headed. So I like it. I mean, as I say, I am long in my portfolios, and I potentially be looking to actually add to exposure now that it's giving this little bit of technical breakout to the upside here.
Yeah. Now, we have touched on one of the main decisions that people have to make at the moment, right? I can buy this in dollars or I can buy it in pounds. Now, when you're seeing 10% moves in currencies in a year, then you have to make that decision becomes a lot more important than it has been for a long time, right?
Well, definitely, and that you're right. I mean, the dollar has been incredibly weak this year. I think I saw a stat that it's the worst first half performance for the US dollar since 2005. So we're talking 21 years, and it's the US dollar index is the most extended that it's been away from its 200-day moving average in also some, I forget this figure now, but a very, very long time.
Yeah.
The dollar is very, very oversold. But to your point, you do need to think about your currency risk here. And I know we were talking off air and talking about our own portfolios and saying, well, you know, we live in the UK, right? Our base currency is pound sterling. So if you own dollar assets, and if you own pound assets, I guess, but what you've seen this year is your performance has been flattered in US dollar terms because of the weak dollar.
Yeah.
Right. But in your base currency being pounds, you might not look so smart because if you've got US dollar holdings, when you convert those back into pounds on a weaker dollar basis, well, you've had a 10% headwind just from the currency this year.
I get a lot of people saying to me, I don't understand, Rich, S&P's at all-time highs, but I've lost money in my ISA. Well, like, what's the difference?
Well, that's and the reason is because your pound is 10% stronger against the dollar since January.
Great if you want to go on holiday.
Yes, exactly. Well, to take your opportunity now, right? Because this is, you know, the dollar is very weak at the moment. But also, and why we bring this up now is because it does look potentially like the dollar is at an extreme now. It's very, very oversold. The positioning, I mean, I saw a Bank of America Merrill Lynch investor survey the other day that showed that the US dollar short or the US dollar underweight is the most extreme that it's been in several years.
That is smart money.
Yeah.
That is positioned that way. So they are going for this idea of the decline of American exceptionalism.
Yeah.
They know that the risks are around Powell and what is going to happen post-Powell. Because no matter what, even if Powell stays till May, that June could have a 100 basis point rate cut.
Theoretically.
Yeah. Well, I mean, you know, because he's going to install somebody who's no longer a... So when you see the 30-year bond up above 5% and you see the dollar collapsing, there's this mismatch, isn't there, between the yield that you can get now and what could happen 12 months from now if he gets his way.
Well, that's right. But that is the risk. And I mean, it's a big risk to the independence of the Fed as well. I mean, that is another whole story. I mean, you know, trying to install someone that is a Trump puppet, that's the kind of thing you see happening in, you know, Turkey. Right, there we go.
I mean, it's, you know, that's not anti-Turkish to say. It has happened, and Erdogan's done it 3 times.
Yes, exactly.
So,
but with that, you know, out the window goes the credibility of the Fed, and the thing is also the market will determine, right? Trump can come in and say, well, we're going to cut interest rates or whatever, but at the end of the day, the bond market is going to determine what the yield is on your 10-year treasuries, on your 30-year treasuries.
Yeah. But what I'm surprised is that equities is completely blind to that. Yeah. And it's completely ignoring the fact that Trump is going to do that.
Yeah.
It's a matter of 9 months away.
Yeah.
And we will not have rates at 4%. He will move the inflation target before he moves rates higher.
Yeah.
And that is the end of the dollar. So you can kind of understand.
But then the point is, you're right, that could be the end of the dollar. But how much of that is already priced in? And that's, to go back to the point about the extreme positioning in short dollar, underweight US dollar, and so on. And there's a lot of noise around this. But in my experience, also, you tend to find that the noise is the loudest at the extremes.
Yeah.
And yes, I can look back and say, well, on a bigger picture basis, the dollar may yet weaken over time. But in the relatively short term, the dollar is very, very oversold now. All of these things that we're talking about are known. Mm-hmm. Is there potential for a surprise that the dollar actually makes a little bit of a snapback and rallies just a bit in the near term? And I'm not talking about a huge rally, but could we sit here in 3 months' time and the dollar is 3 or 4 or maybe % stronger than it is now?
Yeah. And that's not necessarily pounds, because we could have a similar situation sort of in the UK, not central bank, but around the Chancellor and around those policies. So what about the yen? If we want to take a look at the yen here, 148 at the moment, remembering that dollar strength takes this higher, and yen strength takes it lower.
Yeah.
I wonder that's a really interesting sort of tug of war there, isn't it? Because very different things going on in Japan.
Well, very different things. I mean, have you seen what's happened to Japanese bond yields? Right, that bond yield chart is trying to break out through the top of the screen.
Yeah,
and that goes hand in hand with the weakening of the yen as well.
And it's a very tough one to predict what happens there next. But that's probably where you see the most volatility, rather than sterling or.
Yeah, I think the yen, if you're going to trade this view, I mean, the yen does potentially have a lot more room to move. I'm not in a trade on the yen at the moment, I'll say that. I mean, I watch it very closely, but I'm positioned in sterling. And that's purely for, I guess, personal reasons, because what I was saying, we live here, our base currency is sterling. A lot of investments are in sterling, trying to now hedge it, because by no skill of our own, right? If you're invested in sterling this year, you've actually done well.
Yeah.
But you've just by owning owning a property in sterling, owning shares in sterling, whatever you've got that's in sterling, it's done well this year.
The way to look at this, of course, if you've got your ISA and it's sitting in wherever, and it's £20,000, or it's £100,000. Then to you, it's still £100,000. But multiply it by the exchange rate.
Yeah.
And look at the 12-month difference in what your ISA is now worth in dollars. Yeah. And you'll be pretty chuffed.
Well, absolutely. And I did that exercise for myself earlier this week and I thought, wow, I'm up a lot in dollars this year.
Yeah.
And that's not from any skill of my own. But it's purely based on the fact that the dollar's been so weak and the pound has been relatively strong against the dollar, right? Mm-hmm. And I'll say relatively because we're just comparing the pound against the dollar here. The pound in its own right hasn't really been that strong, but against the dollar, it's been pretty strong. But the question is now, what if you want to lock that in?
Yeah.
And say to yourself, okay, I've got effectively more dollars than I started the year with, purely based on the fact that the currency's moved out. How do I protect myself? How do I lock that in?
And so what have you done in this options world then?
So that's it. So through IG and through I'm doing it on the spread trading platform. Mm-hmm. There's options, spread trade options, and I've done a put spread on cable. So essentially the one I've done is, it's out to September, but I've also done one to December as well.
Okay.
Buy 134 puts.
Oh, right. So you're in the money?
I'm in the money slightly now. Buy 134 puts, sell 134 130 puts.
Nice.
But also, in order to try and reduce the premium on the trade, I've also sold out the money. I've sold 140 calls. Now,
this is we haven't spoken about this beforehand. I think I've got pretty much the same trade on.
Okay.
But it's let me just check this. Sorry, where are we? Yeah, 132, 125. But I've done it had done it in 1x2, and I've taken it in now.
Yeah.
So it's similar sort of delta.
Yeah, there we go. So mine is a 1 by 1.2, right? So if I've bought 10 of the 134 puts, I've sold 12 of the 130 puts. So it does introduce a little bit of tail risk on the left-hand side if we see a major collapse, which I don't see coming. But the idea being really, it's a 3-month trade, and I'm saying to myself, could we see
snapback?
Could we see a snapback? Could we see this currency down at 130, 128, somewhere down there by September? I don't think that's beyond the realms of possibility. And by doing that, essentially, I'm just hedging a little bit of my dollar exposure and locking in some of those gains that I talked about in US dollars, which have been made fortuitously just by being, long of sterling assets this year.
That's it. Makes complete sense. Good. Right. A currency a bit more closer to home for you.
Yeah.
Let's have a look at the rand, because that is it's always an interesting one to talk about. There's always something going on, and it's behaving itself quite well.
It's behaving itself well against the dollar, what you're looking at there, and again, that's a story about a weaker dollar. Okay. So if you were to look at the rand against sterling or the rand against the euro, you'd see that it's actually, on a bigger picture basis, the rand is broken out into a weaker trading band. Certainly against the euro. I mean, I don't know if you've got the chart there, but if you don't, the levels are, above. On the euro, it's above 20 rand to the euro. Is a new. There we go. Is that the pound chart you've got there? Yeah. All right. Well, let's talk about that one. That's what you've got.
This is what we used to do all the conversions in, those horrible LSE to SA conversions.
Exactly, but there you go. So have a look at that. What you can see is the price really was in a long sideways band between about 22 rand and 23-ish to the pound. But it kind of now looks like we've broken into a higher trading band between what is probably 24 up to maybe 25.
Yeah.
So the rand, it might look like the rand has been fairly firm against the dollar, but again, that's because the dollar's been weak. When you now look at it against the pound, for example, you can see, well, actually the rand is still relatively weak on that long-term chart.
What's the interest rate in South Africa?
Well, you're up there, north of 8%.
Yeah. So if I'm receiving 8% and I'm paying out 4.25%, I've been quite happy for a couple of years, really.
Oh yeah, but that's your carry trade, and it's always been a big play in South Africa because we've got very deep bond markets, very liquid bond markets, and you can get those higher yields, and that's been a big thing. As long as you hedge out the currency, that's the critical part. You've got to hedge the currency because it's volatile and it can move very quickly for all sorts of reasons.
Yeah.
So yes, playing that carry trade is it can be lucrative, but make sure you hedge the currency risk.
And if you get it right, you can buy a nice little apartment in Cape Town.
You can, and your dollars or sterling or euros goes a very long way down in Cape Town. Yeah.
And still, there's not, has there been inflation as bad as the rest of the world?
In terms of property prices or in terms of just general pricing in South Africa?
More general, yeah.
There has been inflation. Definitely, it's the official inflation rate is somewhere around about 3 or 4%.
Okay.
Their target band for inflation has historically been anywhere between 3 and 6%.
Right.
So it's been well within that band for quite some time. So yes, there's been inflation. When I travel back to South Africa and I have a look at the price of goods on the shelves, you can see prices have moved up. It's still fairly comparable to the UK if in terms of buying groceries and things like that.
Right.
Where your money does go a very, very long way there is when you are buying things like property and eating out. You can go get yourself a really good steak for 10 quid.
And a bottle of red for another 10.
Exactly.
Right, let's look. We've spoken about Anglos quite a lot in the last week. But there's been a spin-off, hasn't there, as they clean up the company. And the spin-off has listed up here in London. Take us through Valterra.
Yeah, so Valterra is what used to be called Anglo Platinum, obviously the platinum arm of Anglo American. And Anglo Platinum was always separately listed, but it was majority owned by Anglo American as the holding company.
Right.
Now, what's happened recently is they've spun it out. So if you were an Anglo American shareholder, you received separate Anglo Platinum shares, which then got renamed to Valterra Platinum.
Yeah.
So essentially, they've spun the whole thing out and separated the businesses entirely, and they are in the process of busy, cutting all the various different connections between the two. I quite like it in the sense that, and I think it's going to take a lot of costs out of Valterra, certainly costs that get paid up to the mothership, up to Anglo American. So that probably boosts the profitability at Valterra on its own.
Yeah.
But also, if you just have a look at Valterra relative to a number of the other platinums that are listed in South Africa, look at it against Impala Platinum or Northern Platinum or Sibanye Stillwater. Those three shares that I've just mentioned have all been running really hard.
Right.
Valterra has been moving higher, but not to the same extent. And the thinking behind the reason is really that there's still an overhang of stock, an overhang of Valterra stock because of that unbundling. A lot of institutions that owned Anglo American would have now received Valterra into their portfolios. They don't necessarily want to own it, so they're slowly but surely leaking those shares out into the market. So there's been an overhang of Valterra in the market. But at the same time, I think that overhang gets absorbed. And as it gets absorbed, you should probably see the potential for Valterra to play catch up to the likes of Impala and Sibanye Stillwater.
Especially when your underlying commodities doing this.
Yeah.
What on earth happened 3 months ago in platinum?
Yeah, so I mean, there was a London Platinum Week conference, which was one of the reasons, which was cited for why we suddenly saw that enormous breakout in platinum.
Right.
There was also an announcement that for the first time in a long time, the platinum industry will actually go into deficit. So there's, in other words, there's more demand than supply, which has been that hasn't been the case for quite some time, and it was why you saw platinum group metals under severe pressure for many years. But all of a sudden, that's unwound now.
Is that from more hybrid vehicles?
Yeah, it's that sort of thing. There's obviously the big industrial demand for platinum, but also, and I don't know how true this is, but I suspect there's some element of truth to it, is that demand for platinum jewelry has picked up as the gold price has rallied. Gold's become more expensive.
Right.
There's been some level of substitution effect towards platinum. And also, just from an investment perspective, there's been talk of people literally wanting to purchase nuggets of platinum like they can buy nuggets of gold or nuggets of silver. Go for platinum. It's also a precious metal.
This thing's done nothing for years.
So all of that kind of combines to drive the platinum price higher. And it's just interesting that this happens at this exact moment when Anglo American have decided they don't want to be involved in platinum anymore, and they're spinning out their platinum assets. It's kind of weird. They did the same with Thungela, which was their coal business a few years ago. They spun that out at the bottom of the cycle, right before the coal cycle picked up, and Thungela shares, once they were separately listed, absolutely, mooned. And I wonder whether they haven't done it again, where we're now seeing, them unbundling an asset right at the bottom of the cycle just before conditions improve.
Yeah, quite possible. Unlikely it will be the same in De Beers, but we'll see.
Yeah, so De Beers is in a difficult spot. Obviously, diamonds and the a drive towards synthetic lab-produced diamonds just mean that De Beers is looking like it's in trouble.
Has Mrs. Mackenzie got a diamond on her finger?
She does, yeah.
She does? Proper one? Not lab.
Yeah, it's a proper one.
There
it's
you
a
go.
proper one, yeah. But I don't know where it was mined from. I don't know. But it's a proper one, yeah.
Yeah. Brilliant. Right, before we go on to talking about podcasts and trading then, let's have a look. Mervyn Jardin in the... Now, this isn't my secret name on the chat because it is pretty much exactly what I'm thinking. Global growth is slowing, right? We are seeing that come through in the numbers all the time. Oil demand is reducing, treasury yield curve inversion flashing red, downgraded debt, ridiculous PE ratios such as Palantir means we're heading for an S&P crash. It just doesn't feel like it's going to come without a catalyst. It's going to need that paper lit.
It would need a catalyst for sure. And I think also what you've got to remember is we've just come off a 20% pullback in the market and the S&P 500.
But we've got the same reasons for that 20% pullback could still stand in a couple of weeks' time.
Yeah, they could.
And we're just ignoring it.
I know. But isn't this the story of the markets? Markets always climb a wall of worry. And, you know, market crashes obviously they grab a lot of headlines. They're always historic. People remember them. But, you know, it's very, very difficult to go through life trying to predict a market crash.
Yeah, and I don't necessarily think it even takes a crash. If we trade back to 6,000 and then just stay there for 12 months, that's much more likely in my view, and it's what should happen.
Yeah.
Because then you're on 20 times next year into a period of growth slowing. And then, you know, you get a little bit of rotation into value and
I think that's fair. I think you're right. I mean, you're talking about sort of a sideways grind. It would be a correction in time if that were to occur, as opposed to a correction in price.
Yeah.
And so you get a market that tracks along sideways, but whilst that's happening, earnings are slowly growing under the surface. The market kind of grows into its elevated PE ratio, and suddenly you could look in 6 or 12 months' time or 18 months' time and say, okay, well, it's not as expensive now as what it looks right now, because right now it does look expensive. It looks like it's priced for perfection.
And when I've got other opportunities elsewhere, you know, of earning a 4.5%, or whether it's corporate bonds or whether it's KWeb or some, you know, stocks more in defensive or value areas, I don't know why I buy Palantir or Nvidia. Same, like it's, you know, these things are priced for absolute perfection.
Yeah, they are.
In fact, Palantir is perfection plus.
It's absurdly expensive, but it has been for a long time. Yep. And I've seen so many analysts with sell recommendations on the stock, and yet it just keeps going up and up and up. And the thing about these kind of companies, I mean, it takes me back to Tesla as well. How many years have we said, oh, Tesla's overvalued and it's ridiculously expensive and it's going to crash? And it was, you know, many analysts had a sell recommendation on it, and it just grew and grew and grew into its earnings. And, you know,
and then it did drop to $100 in 2022.
It did at some point. But I think the point is, you know, as a trader, I'm big on looking at the price action in things and saying, what is the price action telling you? Listen to the price. Because you can have an opinion that Palantir is expensive. Sure, it is. But look at that price action. It's strong. It's strong until it isn't.
But is this change with the composition of who is buying, right? Because the buyers now are ones that don't care for economics. They don't care for understanding valuations. They are buying their favorite names, and they're doing it month after month after month, and they never sell.
Yeah. Well, they never sell maybe until it one day does crash, and then they often end up selling at the bottom. But that's another story for another day. Again, you know, dance close to the door. But,
I like that.
But while the music's playing, you know, and the trends are up and the price action is strong, you either got to be in it or just don't be short. That's the point. Because these kind of things that keep on running in these theme stocks, these story stocks, like a Palantir, like an Nvidia, you know, a lot of people will look at exactly what we're saying. Oh, they're so expensive, it's ridiculous. It's a short. Well, you know what? Markets can remain irrational longer than you can remain solvent. So it's a dangerous game to be, trying to bet against that momentum. Yes, at some point, I'm sure there will be a big correction in those stocks, and some level of common sense will prevail. But we're not there right now.
That's the problem I have when I speak to people, that their view is to hold forever, right?
Yeah.
The probability that Nvidia will be lower at some point in the future is 90%, right?
Yeah.
It will trade at some point lower, is between 88 and 90%. Therefore, why hold it when it is at the risk of any setback pulling it back, when I know I can buy it lower? I only have a 10% chance that we'll never have the chance to buy this lower.
Yeah.
That's what I don't understand. Anyway, these are all, now I know I'm do the Irish exit at the parties. I should dance close to the door.
Yeah.
Now I know what's going wrong.
Stay at the party, just dance close to the door. Run a trailing stop loss on these things.
Yeah.
If you own Nvidia, it's probably wise to downweight it slightly because it's so richly priced. But run some sort of a trailing stop loss. Maybe you watch it, 50-day moving average as a guide. And when it drops below that, well, that's your time to leave the door, right? But until then, well, the music's playing.
And see, now these are all the valid and very valuable lessons that you can learn from listening to Garth's podcasts, Talking with Traders. So we're going to talk about that after the break, coming up in 1 minute.
Okay, guys, before I teach you how to use this, I have to teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready. Time to go. Hey, come on, Pat. Cash returns, come on. Oi! Oh, you're not going to get better than cash returns.
Right, welcome back. So we have Garth McKenzie, who is from Traders Corner and Talking with Traders. Run us through this wonderful website that you've constructed there with, I think, it's almost from our offices, is it, that picture?
Well, it's an old picture because you can see that the Shard is still being built.
Of course.
But yeah, I mean, obviously that's looking up the Thames in London. The website is traderscorner.london. So basically that is where I publish all my market strategy. I do a thing every day called the Daily Desk Journal, looking at what I'm doing in the markets, where I'm seeing opportunities. It's up before 8:30 a.m. South African time, 7:30 a.m. London time.
Nice.
So I'm up early in the morning working on this, putting together some strategies, very much technical analysis focused. And then throughout the week, I have some other reports which are more long-winded, let's say, than the Daily Desk Journal.
And
views on stocks, both international stocks as well as South African stocks, where I have a lot of clients still down there.
Brilliant.
Yeah.
And as for the podcast, we're on number 130, did we say?
Yeah, around about 130. I lost count, but we're thereabouts. So it's Talking with Traders. We started this in 2020 during the pandemic, and actually it was something that IG sponsored at the time. And initially it was supposed to just be 6 episodes, and we would just test the waters. And we did 6, and it was well received. So we thought, let's do another 6. And it kind of just went from there.
That's incredible.
And it grew and grew. So I've had some great guests on over the years, some quite high profile names as well, which has been a privilege to interview, guys like Tom Sosnoff.
Oh, Sosnoff has been on, has he?
Sosnoff's been on from Tasty Trade, and a number of others. So yeah, I mean, it's a privilege to talk to experienced traders, to get their insights, and effectively to get 40 minutes of their time, undivided, and ask them questions. It's a real privilege. And over the years,
exactly what we've stolen from you today.
Well, there we go. Yeah.
Now, take us through what kind of lessons you learned from speaking to that many experienced, professional, and wise traders.
Well, there are so many lessons, but there are certain things that stick out in your mind, and certain little quotes that will always stick with me. What I will say is that all of the traders have different methodologies, different time frames, different ways of analyzing the market. The one thing that all the successful traders do have in common is risk management. Mm-hmm. They keep their losses small and try and maximize their wins. Right. And it really, that is the one commonality that I've seen across all traders. Yeah. And if you read any of Jack Schwager's Market Wizards books, that's also the same commonality that comes across with everybody. But there are many. I mean, one of my guests once said, and it just sounds so obvious, but he said, in this business, you have to take risk to make money. You get paid for taking risk. Yeah. And it sounds obvious, but if you stop and think about it, that a lot of the time people don't appreciate that, or maybe don't understand it at its most basic level. You have to take risk in the market if you want to make a return. If you don't take any risk, you're going to make nothing. But at the same time, you have to manage that risk so that it doesn't wipe you out either. And it's obvious, right? As traders, you have to take risks to make money, and you get paid for taking risk. But if you don't take the risk, you ain't going to get paid.
And there's an easy way to not take any risk in life, and you stay in bed.
Yeah.
Right? What's your payoff there?
Exactly.
Yes, you could get hit by a car on the road. You could, go on holiday. The plane could crash, whatever. But it's always about judging probabilities. Yeah. When to take more risk, versus the return that you think is likely. And that's where, is there a feeling that sometimes 3 or 4 times a year, there are huge opportunities?
Most definitely. And that's the thing that I found throughout my career, is that as a trader, most of your year's returns, actually, when you really look at it, often come from 3 or 4 trades. Mm-hmm. And in between that, you're scratching around, you're making a bit, you're losing a bit, you're making a bit, you're losing a bit. But the point is, and I often liken this to scratching for diamonds. We talked about De Beers, right. So let's take it back there. But I think about it like scratching around for diamonds. You've got to be scratching if you want to find anything. Yeah. You're going to probably find a lot of dirt. You're going to dig up a few small diamonds. But if every once in a while you'll dig out a big diamond. And that's kind of the way I view the market, is I scratch around every day. I'm looking through the charts, looking through the opportunities.
Right.
You don't know when the next big diamond is going to reveal itself, but it's there somewhere.
The diamond's the opportunity, not the profit.
Well, yes.
You're trying to just find that opportunity that sticks out, and you're scratching your head and you think, surely I don't have that growth with that yield at this price.
Yeah. Well, that's it. And you're quite right in saying that there are a handful of these that come around every year. And you've just got to keep your eyes open. Yeah. Look for them. They're not going to fall in your lap. That I can tell you. You need to be doing the work. You need to be scratching around, reading, looking at charts, following the news, seeing what's going on in the world. But by doing that, the opportunities will reveal themselves. And then it's a question of knowing when to act, how to act, but how to manage the risk as well on those things.
Because is there a recurrent theme of when people get burnt and when they take big hits? Upon reflection, would they now know how to miss those?
Well, I think it comes with experience. You learn how to manage risk. Look, every trade that you go into, it's a probabilities game. You don't know whether it's going to be a winner or a loser. Sometimes you can have an opportunity that you think looks like an absolute sitter, and it doesn't work. That's happened to me many times as well. So you've kind of got to go into every trade knowing the risks and knowing what your plan is if it doesn't work out. Where's your stop loss? How big is your position size? Where do you call it quits, right? And I think that's, we talk about a lot of the commonalities of what successful traders do keep losses small and maximize winners. What unsuccessful traders do is the opposite. And unfortunately, we see far too much of that in the retail space, especially where a lot of traders will allow their losses to grow and to the point where they become too big. But they're also then so eager to snatch at small profits. That's not the way to do it, right?
But it is so common, isn't it?
It's so common, and it's kind of human nature. And you've almost got to train that out of yourself as a trader to be comfortable holding winners. And that's not an easy thing to do. In my experience as a trader, the hardest thing to do is knowing the right time to sell, right? Getting a good entry, can do that. Cutting a loss, can do that. Knowing the right time to sell, very, very difficult, because you either often you sell too soon, or maybe you stay too long and overstay your welcome and end up losing some of your profits. So it's a tricky one to navigate, that managing profits as well.
But selling for the right reasons. Not selling because you've made a profit. That's one of the real main keys, is that you see a nice big blue number, and that should have absolutely no effect on whether you choose to stay in the position or come out of it.
Yeah, exactly. Don't trade based on what your P&L is doing. Trade based on what your strategy says, right? Like an example right now, we didn't talk about cryptos, but Bitcoin's broken out. Long MicroStrategy at the moment. Caught a nice break there. It's moving higher. The trade is working, and it's so tempting to grab the profit. But my rules are saying stick it out, because this thing's running. Short interest in the stock is still very high. All the drivers are there for it to actually keep moving higher. Try and
get that chart up, guys.
Try and flex that muscle, that holding on muscle. It's a difficult thing to do, but I mean, look at some of those. Look at that move on the left-hand side of your chart there now. I mean, imagine you rode through that. What would have been so tempting, right, in the bottom left-hand corner of that chart would have been to snatch at that profit once you had it after that breakout. But look at what you would have missed on the upside. And now we sit in
you would have missed that, but you also had another opportunity to buy a stock that doesn't pay a yield.
Exactly.
You could have bought them at the same level. And this is exactly what I think will happen with Palantir. We are here in Palantir, and you will get an opportunity to buy them somewhere down here, whether that's 90, 95, 100. Nothing keeps going up in a straight line. It never has.
No, you're quite right. Nothing does go up in a straight line forever. And especially when you get something that goes parabolic like that, where the chart, the steepness of the trend becomes steeper and steeper and steeper to the point where it almost looks like it's going to fall over backwards. That's often the time to be the most careful. And I mean, I agree with you. I think at some stage you will see Palantir come back again, and you'll get an opportunity to buy it cheaper. But if you're in it now, I mean, I guess my thinking would be, run some sort of a trailing stop loss. Maybe it's a break below the prior week's low is your exit signal. But if it doesn't do that, if it doesn't break below the prior week's low and it keeps on screaming higher and squeezing up and up and up, well, then maybe there's more money to be made. Let the market reveal that the top is in, as opposed to just trying to guess where the top is going to be.
I do think it's different in something like Bitcoin, because Bitcoin isn't necessarily a thing in itself. Maybe gold's the better example, right? Gold isn't a thing. Gold is the opposite of the government and the government's discipline on budgets and the central bank's discipline on things like QE. So all I'm doing is actually being short government discipline. That's my view on holding gold. And therefore, I'll hold this till it's 5,000.
And also what you're also doing by holding gold is you're effectively short fiat currencies.
Same idea.
If you look in history, the one thing that fiat currencies do all over the world is devalue.
Yeah.
Right? But governments print more of it and more of it and more of it. So go back, as far as you want to, and you'll see that over time, fiat currencies devalue. What hasn't devalued is gold. Gold's been the ultimate hedge against, as you say, against governments, against weakness in fiat currencies.
Yeah.
So it's a great hedge. Unfortunately, it doesn't pay you any yield. That's the downside of gold. But it does preserve your purchasing power over the long run.
Right, that is us at 10 o'clock, Garth. Thank you very much. That time has flown. Wonderful to chat.
Thank you for having me.
And yeah, just a reminder on where people can find more of you and the podcast.
So my website's traderscorner.london, and the podcast is on YouTube. It's Talking with Traders, and you can find it there.
Fantastic. Great. Thank you all for joining us today. Discerning Admirer is back. Love it. Talking about the scratching there. And anybody who missed John Mayer on, where are we now? Monday. Then we're going to replay that just now. So the program will go to 10:30 today to make up for our little journey outside in the fire alarm yesterday. But yeah, that is us. Great to chat, and we'll see you again soon.
Thank you.
Thank you all.
Hey, trader friends, welcome back. And we are joined by the one, the only John Mayer from SP Angel. Hey, John, how are you?
Yeah, I'm good. Yeah, nice to see you.
And nice to see you too. I adore patching through to, because I see all these amazing rocks and minerals behind you. Talk us through what you have behind you over there.
We got pieces of spodumene, which contain lithium, some very good copper samples, some very high-grade copper there, some tin. We collect different sorts of ores and cores from around the world. It's just stuff that we pick up as we go around.
I'd love to be there when your luggage goes through security and everything goes off. Beep, beep, beep.
We've had a few moments when we've been stopped and asked for our papers.
Speaking of which, I've got a picture of you in Zimbabwe. This is fascinating. All of our clients and our trader friends here know that you do a lot of traveling. What is this picture, and why is there a huge hole where there seems to be a bridge or a platform?
So this is on the Kavango mineral licenses, and this is an artisanal working. And in fact, the local guys who are, they're not quite digging by hand. They are using explosives. But they use this very, very rudimentary and crude, simple way of getting, of dropping into the workings in order to get at the gold. And in fact, these guys are really good miners. I mean, it's not the safest way of doing things, and it's definitely not modern. It's not a modern way of mining. But this is how it was done traditionally. It's a metal head frame. You've usually got a small motor, and that helps to, which is a winch. You drop people down into the workings, and they dig away. And a lot of it's by hand, and then once a day they'll blast because the rock down there is very hard. But they get a lot of gold out.
And are there lots of people hiding behind and I can't see them, or is it really just like a one-person, one-man band there?
Usually they work in groups of 4 or 5. As you know, they work in teams, and they're very effective. So there'll be about 4 or 5 guys underground, relying on that guy at the top to get them out at the end of the shift.
Nice. That guy's got a really no pressure then.
Yeah, no pressure.
Right.
Well, these guys can climb out without the winch, but the winch is helpful for bringing up the ore.
Right. Let's move on to stocks and commodities now, because we've had silver really heading higher. Gold seems to have eased off a bit at the moment, but gold's still up 0.5% there. What is your outlook at the moment for gold? Are we still seeing this sideways pattern, or are we going to see a move, a breakout move sometime soon?
I think given Donald Trump's big, beautiful bill and the likelihood of that to cause the printing of a lot more US dollars, and the fact that just about every other European country is likely to have to print more cash as well, we see gold breaking out on the upside. Gold is your hedge against inflation, and inflation is not going away.
In fact, looking likely to have even more inflation pressures, right? Upward pressures.
Yeah, if nations print more cash, and I think they've got to cope with the amounts of debt that they have, and the fact that interest rates are at higher levels than anyone had expected. So yes, that ultimately that is inflationary. Whether you see that in the very short term is a moot point, because economies are struggling a little bit. But China's still growing, and everybody has to keep up. And part of the big beautiful bill is so that America can splash more cash and try and keep the pace with China.
So let's talk about whether or not one should lean into the fundamentals of this, or actually do you see more opportunities looking at gold producers, for example?
I think a lot of opportunity for gold producers, because, as I say, there aren't that many new gold mines in the world. The industry's been starved of cash for something like 12, 13 years now. A lot of explorers have been going, they've been forced to go slow. They might have good projects, but they've had to work on them very, very slowly. So the pace of new mine development is shockingly poor at the moment. And I think it will pick up, but we're just beginning to see the first signs of that. So, yeah, I think in a world where there's more physical cash, more paper money, people are going to look for hard assets. Gold, copper, silver, they're all good hard assets that people like to own. If you hold a bar of gold, you understand why you want to own it. So yeah, it's one of those asset classes that continues to do well. It performs in these times of uncertainty.
Let's talk about some of the names. Which ones do you like? I mean, there's Barrick Gold, there's Newmont. Which ones? There's also Newcrest. Which ones do you think have the best upside? For example, for those watching this space, thinking, well, I've traded the price of gold, but I want to look at miners now.
Well, we focus on the smaller companies. Barrick's not my favorite because, well, one, it's a very large company, but two, it's probably lost a key asset in Mali to the government. They've decided to seize that asset back, and in fact, they had a helicopter in there last week taking a ton of gold out of the vault. So that I don't think that's being so well managed. Newmont would be a better play on the larger side of things. But there are other companies, gold, copper companies I would go for. In fact, Barrick did change its name from Barrick Gold to Barrick Mining to highlight that transition. But on the smaller company side, I think there's quite a lot of little companies to look at, which, as I say, have been going slow, but actually have good growth opportunities going forwards, like Ariana, like SolGold. There's quite a lot of these things.
And for those of you watching, if you'd like me to try and get some of these CEOs from these mining companies, do let me know, because they travel widely, and also they often come to London for the Resourcing Tomorrow. We used to be known as Mines and Money, didn't it? I don't know why they changed their name, John, but it's now Resourcing Tomorrow, I believe.
Yeah, well, there's a lot of competition in the mining conference sector. And there's the One-to-One group also manage conferences in London. And the original Mines and Money, I think, was a fantastic event. But it was very traditional in that everybody would troop into a room and listen to some expert speakers and occasionally myself. The format's changed. Everybody seems to want one-on-one meetings with the companies, and that's good. but once you've had 20 one-on-one meetings, it's quite difficult to remember the first one from the last one. So we prefer to actually spend more time individually with the companies. But yeah, they're good opportunities. If you pick 4 or 5 companies that you really want to talk to, I would say that it's a good focus. So use these events, use resourcing tomorrow, use one-to-one, and find out really what's going on. And for, the thing about investing is always invest in a company that you trust and where you really believe in the management. That's the key bit, because good management can take a sort of a slightly rubbish asset and do great things with it. Look at Anglo-Asian Mining, the most fantastic management team operating in Azerbaijan. The assets were never first class, but they have done brilliantly with those assets. And in fact, they're expanding fast in the world of copper going forward. So they've got a new mine that the government has asked them to develop a new mine with them. So I think it's a stock that will go up and up. I should say that we act as nomad and broker to the company.
Interesting stuff. We've got people chiming in on the chat as well. Fortet there saying another reason for gold to go up is that most of it has already been mined, at least what is economically feasible to mine. Do you agree with Fortet, John?
It's getting harder and harder to find the big world-class mines. So, yeah, I mean, Zimbabwe is a place where I think the next generation of new mines is going to come out, but nobody's going to throw billions of dollars at it right now. The government has a slightly onerous, I won't call it a taxation regime, but just a fiscal regime the companies have to work with. But it works. It's the gold assets are good, and the gold assets are developing in the right way. And in fact, the workforce is brilliant. As I say, these artisanal miners really know what they're doing. And you can't get that in lots of places in the world. You couldn't develop a mine on the outskirts of London and find a good workforce for it. It would be very difficult.
RSAC's also chiming in right now. And is it better to go for minus ETF? We have gold minus GBX or junior gold minus GBXJ. So that's a question for you. Do you have a preference?
Personally, I always invest in the underlying equities. I don't go for these basket instruments myself.
Interesting stuff. RSACs, that is John's view. Also, we've got lots of people coming in onto the chat now talking about, top producing countries. Marcus Kane using AI there, saying, in 2024, China 380 tons, Russia 330 tons, Australia 284, and Canada following closely behind that, and the US. Yes, China is a big producer of gold there. Let's cross over to something that's been really hot recently, and that is copper. Right, so your outlook for copper, John. Lots of people here wanting to know what you think is going to happen in this space.
Before I start on that, just with reference to Russia and China, communist systems, when they start to run short of cash, they always use mining and resources, so mining and oil and gas, for revenue. They use it to bolster the coffers. And when money is running short, they forget to put money back into the mines. Mines will always fail if you don't continue to reinvest in them. We saw this during the Russian financial crisis. A lot of the mines effectively collapsed. And so this is something to watch out for. If the Soviet Union collapses financially, then those mines will start to fall apart and the production coming out of them will fail. Now, we don't see that with China right now, but it's always a possibility going forward. So governments should never run mining projects or mining companies. It's only real mining companies where the management is incentivized for longer term, shall we say, production that one should ever invest in. Anyway, going back to the outlook for copper. Look, I mean, the world needs a lot more copper because the world needs to electrify AI data centers. It needs to electrify everyone's electric vehicles. And there's an awful lot of houses that will need recabling as well. So there's no good substitute for copper, and that's an important thing.
Right, we have Rich McDonald here, who I know is very keen on copper.
Great to meet you, John. How are you doing?
Yeah, good.
I was especially interested there when you said about Anglo-Asian mining, and you're an expert in these smaller names. What would be your other names that you'd be particularly interested in at the moment that our viewers can get involved in?
Oh, I hate being put on the spot. Well, we're quite. Yeah, it's very difficult to remember.
I know you said you like Newmont in terms of a bigger sized one.
But if you could have anything.
Yeah.
Yeah, no. Newmont it's always been a class company. I mean, not to say that Barrick is a bad company, but it's just it's undergoing an unfortunate situation in Mali. But they also want to get involved with building a huge copper mine in Baluchistan in the north of Pakistan, which I think is going to be a very, very difficult thing for them. But there are other good players around. I mean, there's I tend to think of the mines more than the company names when I'm under pressure. But Resolute we quite like, but it's a UK and Australian company. They've been operating in Mali, but they have other operations. And Sarabi. Look at Sarabi. They're a good little company operating out in Brazil. That seems to work well for them.
In terms of commodity choice, John, what order of preference would you put in where you think there's strong fundamentals in commodities?
Well, for me, I always want to buy copper. Tin is another one. Tin is a bit more. It's a bit more of a wild commodity because it's less liquid. It's less well traded. But it does that. You can't get tin from many parts of the world. And in fact, the Cornish tin mining industry. If we look at South Crofty, the old South Crofty mine, which is where I started my career.
Carlo Verda, knowing his tin stuff. Carlo Verda in the chat saying tin South Crofty. You're from that region by any chance?
I'm not from that region, but that's where I started my mining career. So Cornish Metals is the company, and I'm very proud for the fact that we act as nomad and broker for them. So yeah, I mean, I'm really looking forward to the restart of that mine. There's lots of tin down there. There's no doubt about that, and they are getting on with it. They're certainly pushing ahead. They've been broadening the expertise within the team. Having that expertise is all important, and there are a lot of they finished mining, and that mine finished at the end of the 90s. So there are guys around who know how it works. And the good thing is they actually started using some very new modern mining techniques in the last few years. So we know that those techniques work underground. It'll give us a very good idea on the economics going forwards.
Speaking of economics, you talked about copper earlier, and you said Rich was asking you out in the order, which ones you would go with most. You said you really like copper, everyone should have copper. Do you like the fact, John, that copper, in terms of Chinese demand, has seen a bit of a bounce recently? I mean, is this just a blip, or do you think it's a longer term trend that there's going to be more demand from copper from now on?
I think there's definitely a longer-term trend for more demand. As I say, electric vehicles and data centers are just two of the key drivers. But there's national grid systems need almost rebuilding. I mean, we all rely on electricity for just about everything we do these days, and if the grid network has to be robust. Yes, we have two-phase electricity that we all use. If you want to run a heat pump and an electric vehicle, you need three-phase electricity. That means you need recabling. So there's a lot more work to be done to make sure that consumers get the power that they're going to want going forward.
Why has it struggled so much, though? Because I know, Goldman's were talking about this in 2022, and we've been waiting for copper, and the only thing that's ended up driving it is a bloody tariff on top of it. Well, why is the surplus not been eaten away yet?
Well, the mining industry is always trying to grow. So we had about 3% growth in copper production last year. If anything, I think we're going to see a deficit by the end of this year. And in fact, we'll almost certainly see a deficit in Asia because so much physical metal has been dragged into the US. That metal's gone to the US because of premium prices out there, largely on the back of Donald Trump's Section 232 tariff investigation on the copper industry, which is madness, let's face it. I mean, the idea of having huge copper tariffs between America and the rest of the world doesn't make sense to those of us who are looking at it. But it is creating this enormous distortion. And so a lot of metal that the Chinese would have wanted to use to expand their grid systems, to connect more solar farms, more wind farms, and more nuclear power stations, is now in America. So they're going to have to work even harder to find that metal.
To illustrate what Rich was saying, just showing up this chart to show you, the one thing that's actually caused, this copper futures to jump there, which is these tariffs. So overall, though, there's a lot of data points there showing that you'll just see all this additional cost being passed on to consumers. Is that your expectation, John?
Well, yes, I'm afraid it will be inflationary, certainly in the United States. And it probably creates a little bit of inflation elsewhere in the world.
Would you still go on the LME then, if for our guys that were looking at trading it, or the HGA's now COMEX is underpinned, or how would you play it? Or would you go for some of the smaller names that are leveraged into it?
I think Trump is going to have to unwind this tariff proposal. I mean, they haven't actually come out with what the real tariff is, but I think they'll have to roll back on it to a very large degree. So I would be buying the LME and selling COMEX, but that's
okay.
What do I know? I'm not a professional copper trader.
Yeah, and then what about the companies that are leveraged into this potential move if we do go into deficit?
Well, certainly they'll do well. Antofagasta, Rio Tinto, Glencore, BHP, they're all very, very well placed to benefit from this, and even Anglo-Asian mining.
So Anglo-Asian mining, is that sort of full copper, or what's the breakdown, John?
They are transitioning from gold to copper, partially because of the resources they're working on, and because of the new mine that they'll be restarting next year. So what are they going to be? They'll end up 2/3 copper, 1/3 gold, I think, in the next few.
And that's with new production coming on next year.
Yes, yeah. So I'm kind of making a bit of a guess. I'm not the analyst on that stock, but it's definitely going in that direction.
And then what about generally? So obviously BHP tried to take a grab on Anglo's for their copper. Do you think there'll be more M&A because of the outlook of over the next few years, and what a struggle it is to get production online?
Well, what we see in the industry is if any new copper project comes along and it looks like it might turn into a world-class project, it gets acquired very quickly. And we see this time and time again. So it's important to, we've got a team of guys looking around the world trying to keep an eye out for what's promising in this world. I mean, not just copper. We're looking for gold mines, tin mines, silver mines, that sort of thing. But that's where the money's made.
Just switching over to platinum, R6Senna asking if you had any thoughts on Sylvania Platinum.
Yeah, it's an interesting one because hybrid vehicles have given PGMs, platinum, palladium, rhodium, ruthenium. It's given them another lease of life. We all thought that electric vehicles would really see the end of these sorts of auto catalysts, but actually it's not working that way. Hybrids are working well for now. Electric vehicles have still got a way to go before they beat hybrids in terms of many performance metrics. So it's definitely PGMs are going to do well for a while, and because of the situation.
What is your duration? Because there was this expectation that it would do well, and then Trump 2.0 happened, and then it pretty much took its foot off the pedal.
Yeah, I mean, certainly while Trump's in power, they're not going to be pushing electric vehicles in the States. And in fact, they tend to drive bigger mileages in the US anyway. So EVs have got a way to go before they really crack the US market. And let's face it, petrol and diesel engines have become increasingly efficient. So the benefit is less than it was. I mean, I'm still a huge fan of electric vehicles. My next car, I'm sure, will be electric, but I'm still waiting for better battery range. I won't say better reliability, but there's, the motors are becoming more efficient, the control systems are becoming more efficient, and the batteries are just getting better and cheaper. So why not a little bit?
RK asking, any thoughts on MP materials? And
so we're on rare earth now. Yeah, look, rare earth, really important business, because we need rare earths for the permanent magnets. And Tesla tried using non-permanent magnets in their cars, and they very quickly rolled back from that. Your car will be much more efficient. It'll work much better if it's got permanent magnets in the motors and in all the other control systems as well, the door locks and stuff like that. So yeah, MP materials, not a bad idea. You've got Macango, you've got Rainbow Rare Earths, and there's something called Ionic in Australia. So there are a few companies out there that are working on rare earth processing. So they're all working on the reprocessing of waste materials, recycled materials. So Macango, where we act as nomad and broker, is one of those. And the stock's done well recently. It's there's so much going on in that space. And I do think actually Rainbow will go better, because Rainbow, at some point they're going to get that processing, that mineral processing bit right, and then I think they'll become an important company.
John, thank you so much. I think we could talk all day on it's such a great sector.
Telling lots of people that you will get to those questions, and I will get those questions to you over email and then get them back to our clients. But it's such an interesting space. We just don't have enough time.
Last question would be, do you think, back in the day, obviously we had the Mick Davis was the one that used to really drive the M&A in the sector. Do you think there's still M&A to be done in the big names?
Oh, there's loads of it. Yes, I think BHP will come back for Anglo. They are all looking around for assets to buy. They've got lots of cash. I think they definitely. I mean, I know you can earn huge rates of interest very easily by investing in treasuries, but ultimately everybody needs some proof against inflation. They need a hedge there, and the mining companies, it's their business to develop mines, so they've got to find new mines to develop. And that we talk to the guys in the exploration teams at Rios and BHP and Anglos, and they tell us what they're looking for. They are very, very busy out there looking for the next wins.
Right, and that Anglos ticks some boxes there.
Well, Anglos is an easy way of acquiring a lot of copper production. If you think copper prices are going up, if you think you can improve the portfolio, Anglos is a very easy win. And maybe the Glencore go for it. It doesn't have to be BHP.
And sorry, as I say, I could keep asking questions, of course, but that's golden, and Axel's going to drag us out. John, thank you so much.
Thank you so much, John. We are so lucky to have you here so that we can ask you all these amazing questions. Tons more. We'll get them emailed to you, and then I'll get it back to our clients. Thank you so much, John. We'll speak later.
Thank you.
Trump threatens to fire Powell, and the NASDAQ notches its highest close of the year. It's Wednesday, July 16th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan, to take you through the rest of this hour. Futures market closes at 5 Eastern, 4 Central. If you're joining us on the platform, Tasty Trade, or the website, tastylive.com, thank you. Come on over to YouTube, though. Tell us what you think of the market action today. The Trump roller coaster that we all strapped in for this morning when indeed we saw a report from CBS News that Donald Trump was thinking about firing Jerome Powell, went so far as to bring the idea to some House Republicans, and the chummy friends were, well, encouraging him to do so. That was confirmed by the White House this morning. And then about an hour later, Trump came out and said, no, I'm not, me? Fire Powell? Who would suggest such a thing? And the markets quickly snapped back. But it really was a window where the market told you how it would react if that was a reality. Dollar was down, you had gold up, stocks were down, bonds were down. It was that sell America world that we saw in early April. And that early April world gave us a Donald Trump who said things were too yippy to keep going down that path. So he got a glimpse into that window today. And, well, toothpaste back in the tube for now. NASDAQ finishes up in positive territory, and that is a cheeky high close of the year, technically moving above yesterday's close of 23,056.75. We notched 23,000.
Technically is the key word there.
76.50. Dylan, you're overseas. You're watching these fireworks, this topsy-turvy market today. What did we learn from Trump's?
I mean, I really agree with Ilya. I just feel like I feel a reassurance that the bond market's more powerful than the president, because there's no checks and balances in the government. The Congress is useless. The executive leadership of America has no resistance. And if it wasn't for the global bond market, there would literally be nothing to stop the president. And so I believe it's a second confirmation of the bond market's relevance as the final arbiter of what policies will and will not be tolerated. Now, with that said, the dollar's been destroyed, so I don't know. It's not exactly a totally reliable thing. But I think that that the story of the day is the bond market stops the president from firing. If you're writing the headlines for Bloomberg or the Wall Street Journal, bond traders stopped the American president from firing Fed chief.
Ilya, was it the bond market today melting down again? Was it the stock market melting down? Was Tom right that it was the text messages he was receiving, or trial balloon rumor? Is this something we need to pay attention to, is my point, because I look at volatility collapsing across the curve, spot VIX, futures. The market's not saying this is something that we should be worried about.
No, I don't think this is something that we should be worried about because I think it was a trial balloon. I think the trial demonstrated that this is not a road to go down. I think the president went in April and told the markets all kinds of scary things about tariffs and brought out a foam board and did this whole thing. And within a day or two had to walk it all back because the markets told him, no, bad, stop it, in a very emphatic kind of way. We just saw the temporal life of a similar kind of shock here get squeezed to an hour. So what took him 24, 48 hours last time to realize, maybe even a few days, it took him 1 hour to walk back. So I think very clearly the markets are saying, look, you can't go and mess with the independence of the Fed. That's just not a thing we're going to allow to happen. But that's too far. We will blow up your whole agenda. And I think the thing that immediately sort of sticks out is they sold bonds, so they drove up yields. What could possibly be more counterintuitive to what the president would want to achieve by installing a dovish stooge at the Fed if doing so drove up yields instead of driving them down? So very quickly, the markets sort of disabused the White House of the notion that any of this makes any sense. And you can kind of tell by what the president said. When he was asked, he didn't just say, no, it wasn't me. He had command of the details. He came out and said, no, in 8 months is when we'll do this.
which would be appropriate. In 8 months, Powell's term expires. So it's not like the president doesn't know what's going on. It's not like this was some off the cuff thing where he's like, oh, whoops, I've said the thing I shouldn't have said. No. So I don't think this is anything to worry about. I don't think we're going to get an attempt to do this. I think we are probably going to get rhetoric around it. And I mean, we saw Mike Johnson come out today, the House Speaker, and say, oh, it'd be good if we had a leadership change at the Fed. Yeah, okay. So we're going to have the conversation. It's not going to be anything to, it's not going to be any much more lasting, though, as far as its influence on prices, in my mind, than how we looked at oil during the Israel-Iran conflict. There's going to be jitters around headlines, but I don't think it ultimately means.
But don't you think this? I mean, I said this to Tom earlier on Truth or Skepticism, where like, if you sell oil on World War III and you buy stocks on tariff dips, I think you definitely buy whatever stocks or whatever it may be on Fed Chief Powell firing actions. I think those are all buying.
I don't think you buy stocks. I think you buy dollars.
Okay, fair enough. But but the point is, it's an entry point. It's not going to happen,
right?
And maybe
I wasn't long. I didn't get any more long dollars on this today when the dollar sold off for a hot hour.
Hit its 50-day moving average yesterday.
Didn't exit anything.
Sold off today, right? Yesterday. Hits the 50
but
today.
Don't you think that there's a bigger issue here, which is that the economy has a drag from these tariffs? Inflation is back. You know, I mean, like we have a real. I feel like we're sort of talking about the soap opera, but meanwhile, there's like a foundational problem that is afoot here that is not a good one, my friends. Not a good one.
Exactly. That's exactly right. The PPI data showed it again, and that wasn't helpful, surely. CPI, obviously, earlier in the week. The PPI numbers were a great example of this kind of like, you look at the headline and you go, well, this is okay, right? And then you look like an inch under the hood and go, oh, Christ, this is not okay at all. And so I think now in the second half of the year, Dylan, exactly to your point, you're past the soap opera that was the first half, and now you've got to look at what's actually going on. The problem is the grenade thrower in chief keeps throwing grenades. But
the derivative effect of the grenade throwing is a higher cost of everything. I mean, instead of paying attention to the grenades, it's like pay attention to the damage to the terra firma, the restructuring of the foundation of the current. The U.S. dollar isn't what it was 6 months ago, and inflation is back.
Right.
Yeah. Well,
and
people are taking
retail sales tomorrow, consumer confidence on Friday. It'll be a real good test of all of this.
People were taking a victory lap on inflation this morning with the PPI report. PPI doesn't measure imports. So if you're going to measure tariff inflation vis-a-vis PPI, it would only happen through a later stage of the production process,
or really early, which is where it showed up,
like steel, right?
Intermediate trade services margins for the initial stages of the U.S.-based supply chain had their biggest margin squeeze in April since 2012, I want to say. I'll verify that in a second. I've got the chart here, but huge squeeze. They haven't improved since. They haven't fallen, but by the same magnitude. But they've inched lower. That's the biggest in 12 years. Excuse me.
Yeah, no, but that's notable though, right? Because if PPI doesn't measure imports, and so you can't measure the tariff impact directly, you'd have to go into a very minuscule line item and sniff it out. Yeah, and only if there's legitimate pressure in the system would it show up there, and it is.
Yes.
The CPI report yesterday showed that without the weakness in the housing data, tariffs would have had a bigger upside influence on the inflation number. There's actually more weakness going on in housing than I think we've all given any credit to. Maybe that weakness and the reset that you guys have long discussed as what's needed for the housing market, maybe that's actually starting to build in some places where when you look around the country, Nashville, Portland, Austin, Atlanta, some of these places have double-digit year-over-year declines in rent prices. So it's okay. That aside, though, the reaction
and wholesale goods prices in the PPI did go up by the most since February. So it is there.
Right, it's there, but you're not going to see it in the top line. So I mean,
no,
JD
you're not going to see it in the
Vance,
top line because services are falling, and they're falling for the wrong reasons. The biggest decline in services was the traveler accommodations and airlines. So you're seeing that at the front of the supply chain, margins are getting squeezed at levels we haven't seen in over a decade. And at the top of the supply chain, wholesalers are basically belt tightening. They're saying, don't take a flight. Don't spend the money.
Dylan, I got a comment here earlier from someone saying the reason why Trump is pushing on lower rates is he probably thinks that he has some properties that need refinancing due. Why is Trump leaning so hard on these rate cuts? He said that interest rates should be a full 3 points lower.
Trump believes that cheaper money, because Trump's a real estate guy who believes if you reduce rates, you get more action. And he's an action man. Doesn't care about the currency, doesn't care about inflation. And he's a simple math. He's like, listen, if I can get, what's the monthly payment on the mortgage for the building? And if I can drop the monthly payment on the mortgage for the building, the value of my building goes up. I believe he is completely disconnected from the consequences that are manifesting both on the inflation side and on the currency side, and is singularly focused on rates because that's the thing he understands. Or that's the that's the thing he values. That's the important KPI for him, which is if rates are up, the world is lousy. If rates are down, the world is good. Lower and if I get lower, he doesn't understand that lower rates actually going to propel inflation. And he thinks that the solution, my perception, I don't know what he thinks. My perception of what he thinks is that the offset to the drag of tariffs is lower rates, as opposed to I think most economists and the Fed chief believe that lower rates would compound the inflation. There's one worldview, which is lower rates compounds the inflation problems created by tariffs, which I think is the sort of logical economist mathematical view. And then there's the Trumpian view, which is I'm raising the cost of everything on the tariff side, so I need to lower the cost of debt, of borrowing money as an offset to the elevated cost of foreign imports of any kind, while America retools for the next 40 years building domestic factories. So we're going to need low rates for a generation in order to wait for the climate to change enough so that we can grow our own coffee.
That is true. We may have a burgeoning banana and coffee industry soon. Dylan, maybe you have a point there. Ilya, is it just a function of that? I mean, I'm thinking about this from the real estate perspective. If he has lower rates, then the value of his property goes up and his cap rates fall, and his investments look more stable to his lenders. I suppose there's that angle. But I think Dylan, you're spot on. Ilya, do you have any critique of what Dylan had to say? Because I have certainly nothing to add there.
No, I mean, I think we're looking at a situation here where the president clearly wants lower rates for all of the various things that we've just outlined. He wants an economic boom, even though it'll be short term, even though it'll be inflationary, because that's what helps the immediate optics. You could run on that in the midterms. I think that's helpful. Never mind that in the back half of the the 4-year term here, you're going to have inflation. I mean, it's not like we haven't seen this. What happened with the tax cuts in 2017? Why was the president so mad at Powell then? Because what the president did with those tax cuts is he ramped up inflation. And Powell had to go and hike rates. So it's not like this is shocking. And of course, the president, just as he stoked inflation then and forced the Fed to be more hawkish, just as that happened. But he also started the first rounds of the trade war with China and then crashed an overheated economy. Before COVID, in 2019, U.S. growth was at a 6-year low. The pandemic obviously washes over all of that. Everybody tends to forget because, of course, immediately the following year, we got walloped by something huge. But by 2019, U.S. growth was already very weak. And it was because of the dual impact of, A, the short-term thinking on taxes and their implications for inflation, and then, on top of it, a trade war. So, the short-term thinking there. This isn't different. It's the same.
Taking a quick look at the equity markets here, we cover 25 sectors. 7 of them are in the red. The other 18 are in the green, led higher by biotech. Can't help but notice a lot of real estate and bank-related names are leading the way higher too here. IYR, VNQ, throw in a KRE or even an XLF with some of the earnings reports that have come out. On the downside, we see that's the energy names, XOP, OIH, IYE, XLE. SMH took some cream off the top in today's session. But I want to focus on those energy names here because we do find ourselves looking down the barrel at a crude oil market that's now settled back into the midpoint of its range. Dylan, we're not going to spend a lot of time around here because there's no geopolitics and you've made your dislike for oil unless there's a geopolitical flare clear.
Well, it's not dislike. I just don't want to. I'm willing to go out on a limb in public and say, listen, I think it's a good time to do. I just don't feel comfortable expressing an opinion about its direction. I don't know. You know, like
sure.
where I don't want to. I hate to say things when I don't have any idea.
No, I think that's a good point, just to be able to say, I mean, all of us should, I should do that more. Be like, I don't have an opinion on this. This one I actually do have an opinion on, though, Ilya, because the range continues to sideways shuffle. We're sitting right around the midpoint, 63.5 to 65 or so. What's your take on how oil moved today around these headlines? Obviously, Powell gone, growth scare active.
Yeah. I mean, I think you don't get much of anything here absent that spook. So you get a drop, you get a wick, and ultimately you're kind of back to where you were. It doesn't really seem like there's much to consider here. This is still the story of we had a big geopolitical scare. The markets shot up, then were quickly pushed back down, and now they're kind of skidding. It's like a tennis ball that's been dropped from a high and is now kind of bouncing along the ground after the first hit. There's not really anything that's occurring here. We're still kind of in this fair value-ish mid-range. So I think now that we're in the second half of the week, and we've sort of seen the first half, which was about inflation and whether the Fed has the green light to go, and the answer is no. Now we're in the part of the week where we ask, well, why do the markets want the Fed to go? We're in the growth concerns part of the week. And really, if you look at the price action in the first 6 months of the year, I've said this recently, you get a very clear story about what the markets are thinking. Yields are down across the curve in the first 6 months of the year, and crude oil ends up with an over 9% loss for all the fire and fury of Israel, Iran, blah, 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 blah. So the markets are concerned about growth. They want rate cuts. They don't see sovereign risks like what we saw episodically today. Why do they want these rate cuts? Why are they concerned about growth? How is oil down 9% in the first half of the year with all of what we saw on the geopolitics side of things? Well, obviously the market thinks demand is a much bigger concern than supply disruption. And in the second half of the week here, we're going to get retail sales, and then we're going to get the consumer confidence number. And if all of that is telling us things are soggy at the same time that both CPI and PPI are telling us that tariff-linked inflation is finally surfacing, this is not going to look very good for second quarter GDP numbers or thereafter at all. And in the first quarter, we already had weak consumption. As I've been saying, the weakest in almost 2 years. So if all of this adds up to we have weak consumption, which means weak growth, and the Fed cannot and will not do anything about it, a cyclical asset like oil isn't going to find it to be smooth sailing. But I don't think you have the confirmation to be a seller here. I think you've got to essentially wait for a clean break, let's call it sub 63, where you have that center line there. And then it's a sell down into the 50s and maybe further.
Yeah, I'm still leaning the short iron condors there, just like I am in notes and bonds still, which today a bit of a bounce back. I was looking a little stickier there. Dylan, it poses a really, you asked the question, and I think maybe Tom asked the question on the last call, is this done? Is this Powell-Trump story finished now? As Trump said today, we're getting someone new in 8 months. He can get what he wants, he just can't get it as quick as he wants, so why bother the market? Let Powell go out with dignity. You get your guy in there, it's all done above board. The rest of the FOMC is not going to resist the appointee like some plant. Why not take a shot at long bonds? We're currently sitting near 111. We just bounced off of the 111 area today. Or is just what's happening in DC too chaotic and the market?
No, I think I like long bond. I like that. I like long bonds, long dollar.
Yeah,
my attitude is on the Trump side, it's buy the dip. When Trump rattles the cage, you buy the assets, whether it's the bond or the dollar. My concern is inflation and an economic slowdown. I think anything that's sort of in this sort of extreme moves, the same as an oil spike should be sold on World War III. The bond I think is all yipped up on Powell termination fears, which makes it I think a worthwhile long position. I just don't, the issue is oil doesn't have inflation on the other side. I mean, I guess it does in a certain sense, but if anything, inflation sort of, anyway, it's a different, it's relevant in a different way. In this case, if it was just Trump and there wasn't inflation, you'd buy bonds all day, in my opinion. But because the inflation data is there and because rate cuts are going to be kicked down the road, I still don't know exactly how to decipher how much of the bond is sort of yippiness around Trump and how much of the bond is bona fide repricing of assets because of the return of inflation because of the Trump tax policies.
Ilya, you're already there. Are you going to stick with it?
Yes. Why? I mean, I think the risk reward at these lows looks good. I don't think that you've really shown anything has been proven wrong here because you're very close to the bottom, going all the way back to those April levels, and really even before that. I mean, if you look at where we are on ZB, these are bottoms that go back to January, and you're basically hugging them right here. So I think the overall story here becomes of just pure risk aversion of the most basic kind out of a really regular, normal cyclical concern. Oh no, the economy is slowing. Oh no, the Fed won't come to the rescue quickly. This is just baseline de-risking. We're going to need rate cuts. That makes bonds at these levels attractive in the sense that locking in these rates is probably a good idea, because the longer that the Fed lets this thing fester and the more the data makes it obvious, the likelier it is that they really do have to cut, and then yields come down. So why not lock them in here? You're probably near some kind of a cycle top as far as rates go. You have all the reason in the world to look at long-term bonds as some kind of a haven in times of risk-off markets, as, again, we clearly saw in the first half of the year for all the Liberation Day nonsense and the Sell America narrative and blah, blah, blah. 10-year yields fell in the first half of the year. The markets were perfectly happy to buy long-term U.S. debt. There is no sovereign risk concern that anybody really cares about. Now, does that mean that the U.S. is doing fine and managing the fiscal side well? No. It just means that there's no alternative. There's nothing else that's going to come in.
And that was what I was talking to Tom about, because you can sort of just run this thing into the ground, but then it's like where it goes back to 2009. Where are you going to go? Yeah. London? Tokyo? Hong Kong?
There isn't anywhere to go.
You got to come to Milan? Good luck.
Yeah, there isn't anywhere to go.
Load up on BTPs and hope the Italian government doesn't collapse again.
I mean, that shows that's a little bit of a hearkening of the past. Italy is in a very has the most stable government that it has had since World War II, and has the most popular leader in
Dylan,
the free world.
Why do you have to say the most stable government since World War II? How many governments has Italy had since World War II, Dylan?
Listen, buddy. Look
at who's the president of since 10 years ago.
I don't see anything funny with this. I don't see anything. Prime Minister Meloni is the most popular world leader on earth. And she has been
certainly up there.
She is the most popular leader.
In the G10, for sure.
She's the 70th prime minister.
Oh, you're telling me the prime minister of Bhutan rates above her? There's some? You're telling me that some world leader in country number 77?
I think Mark Carney is up there in Canada at this point.
Now we have to fact check this, Dylan.
Ask ChatGPT. Ask ChatGPT. That's why God invented ChatGPT. But there's no alternative to the United States. I mean, that's why I think you got to like the dollar and all the rest of it. I mean, it's as bad as it gets. Where are you going to go?
Exactly right. At the end of the day, it's a game of liquidity. So, and the 08-09 example is the perfect example. The mortgage crisis, all of the pain is in the U.S. So what do markets do? They buy dollars. Why? Because where else do you get cash that's liquid enough to absorb everybody's margin calls? Nowhere.
Modi currently ranks as the top leader.
According to who?
According to what?
A global survey conducted by Visual Capitalist, which is a company that
he's running a Muslim genocide. That is not a good way to make friends, sir.
And also, there's got to be, if it's a survey, there's got to be a population component.
I'm gonna stand by. This is nonsense.
It's just probably the Pope. I don't know. I'm pulling up the graphic.
You know what? Maybe.
So tell me why I shouldn't buy. Inflation is the only thing that keeps me from buying bonds. What is this? This is nonsense.
This is the list.
Malay is up there.
Morning Consult conducted the polls. That's a reputable polling company. Let's get that ad off the screen. We don't need you advertising. Yeah, there you go. Modi. It's based on polling from each individual country. I mean, so like Modi.
GPT, is Meloni the world's most popular leader? No. Giorgia Meloni is not currently the world's most popular leader.
That's based on the poll that is probably reading here. I digress. So
Nayib Bukele of El Salvador, 91% approval.
That wouldn't surprise me.
When you jail anybody that answers the survey wrong, that's going to happen.
I mean, that'll juice the numbers.
Yeah,
that will juice the numbers.
That's a little bit of a cheat code there for Nayib Bukele.
So
Okay.
we have
Vladimir Putin. Vladimir Putin, number 2.
Oh, off the
Speaking
charts.
of 78%.
questioning my
Don't
sources.
fall out of a window now.
Listen, I think that the dictators rate high because if you don't say yes, you go to jail. I think
Right.
I think Modi, because that's right now. I got Bukele 1, Putin 2, and Modi 3.
As a former Soviet, I have some familiarity with how this works.
So we turn our attention to the crypto market here, where anti-dollar is still strong. Ethereum up 11.8%. Oh my goodness, that's a heck of a
This
day.
capital's got to chase something.
Got to chase something. Bitcoin's up 2.87%, closes above 120 here. We see that there's a few pieces of legislation that are making their way through. The Genius Act looks like it passes the vote to go to the floor. Same thing with the Clarity Act. Republicans carried across the line. And so crypto here is having its time in the sun. It's a reversal of yesterday when the legislation stalled out and failed. But moving forward here now, Dylan, because you are a true believer in morals and making money, what's your stance here on Bitcoin? You've been constructive on buying all the shiny stuff. Is this still a shiny object?
No, I mean, I think it is. I don't know what else to say. The short answer is yes. I mean, I'm horrified. I'm disturbed, but I just got to put it in a box and stick it on the shelf and wait for the crypto gods to send me back more money and just not talk about it with the Pope.
Ilya, what is it going to take to get you on this train?
I mean, I'm not getting on this train not for tactical reasons. I'm not getting on it for philosophical reasons. It's just not an asset that I want to own. But I don't really see a particularly compelling technical reason to own it. I mean, even just let's take all considerations of what the ticker is out of the equation. Take a look at a monthly chart, a weekly chart. You're setting higher highs, but momentum's fading. Stocks can't seem to get out of their own way. And as we talked about really all week this week, crypto was mirroring the stock market from the end of last year into the turning point in February, into the turning point in April, into the stalling at the start of, let's call it late May into June. But stocks have since roared higher, and crypto was stuck from late May until basically a few days ago, a week ago, maybe. So this is in many ways catch up to what before a brief deviation for about a month and some change was just a more volatile version of a risk-on asset, just a broad sentiment asset, just leveraged up with Bitcoin level volatility. But this was basically the NASDAQ or the S&P. And then crypto underperformed. So I don't really see anything here that should compel anyone to think that this has a tremendous amount of legs to go. It's going to catch up, but if sentiment is going to turn, as I think we're all kind of looking at and saying, okay, well, the runway for stocks is short on the upside and long on the downside. If that's what this is, in a risk-off scenario where correlations go to 1, high beta assets like this are going to get smoked. So I have no appetite here whatsoever.
Dylan, this is a fun headline. We don't ever talk about this company. Trump says that he's talked with the executives at Coca-Cola who have agreed to take corn syrup out and put sugar back in. Do you have any thoughts on that?
This is like a health improvement?
I think regular sugar
Maha sort of
but
thing.
I mean, but this is sort of like a demonstration of Maha at work, like taking corn syrup out and putting sugar in.
Yeah, screw those people in Iowa. Let's support the Cuban farmers.
I believe that the screw Iowa concept is long overdue.
Oh,
I
really?
believe Oh, yeah. I believe the Iowans have been jacking us up for decades with their silly primary and all their ethanol racket and their corn syrup racket.
Ethanol is a racket. Corn syrup's killing us.
I believe the Iowans, the whole Iowan jack-up, is one of the great corruptions of American society.
And they just kind of hide there in the middle of the country.
And meanwhile, they've got everybody fat as a pig. They're jacking our gas with corn. The soil's been completely corrupted and degraded by the nitrogen fertilizer that they use to jack the corn all over the place.
But this isn't a problem you have with the Nebraskans or the South Dakotans. This is a very...
No, because they don't do the first... They're not the bellwether for who's the next president. So the Nebraskans and the Kansans and these other fools are just in there riding on the tailwinds of the Iowans. But the Iowans have got the whole country by the balls, and they're squeezing a little too hard, in my opinion. And I've had it. I mean, we're in a situation where we can't allow the Iowans, just because they dictate the momentum for the fundraising for who the next president is, to poison the entire country, poison the entire country's soil, set a standard for every other state to poison the country. And I could not be more subjectively and objectively in favor of this marvelous decision from the President of the United States to get the corn syrup out and put the sugar in. So that's how I feel about that. Yeah.
It's not where I thought we were going to go with it, but that's a place.
Listen, you asked, I answered. That's what we do.
That's this relationship. No, but there's just something here. Like this isn't the first piece of news where we've seen corporate meddling by the president, right? I find it really interesting. I don't know if you guys saw the news this week, but MP Materials, they produce magnets. The Pentagon took a substantial stake in this company. So did Apple, which I found to be interesting as well. But this is an immense investment, hundreds of millions of dollars, into a private corporation where the Pentagon basically gets right of first refusal on the magnets that they make. Dylan, is this a step in the right direction? And I say that as someone who thinks we need a robust industrial policy to counter what's happening in China. Should we have more federal government involvement in corporate affairs?
No. I mean, no. I mean, the government needs to have an intelligent tax policy to drive investment, private sector investment, in the development of critical resources. The primary issue with this country is the issue of tax policy. Every single time anybody gets into political leadership, left, right, center, instead of actually addressing the underlying issues of tax policy, they ultimately always come back to allowing the corrupted tax policy to function forever. And then they actually try to exert more centralized control. They're like, I'll take all the money and I'll decide. I mean, they go full Russian oligarch. And instead of having a decentralized, distributed capitalist system, whether it's the Bernie plan or the Trump plan or the Biden plan or the Obama plan or whoever's plan, the plan is always give me the biggest pile of money and I will decide what to do with it. And as long as the instinct is for whoever the political leadership to come out and say, give me the money and I'll decide, the more this country is going to be screwed up. And the more we actually drive a tax policy that encourages distributed pools of private capital to take risk and adapt, then we will see prosperity. So anything that goes towards the control of resources and the consolidation of resources by the Trump administration or any administration, for them to then pick winners and losers, is catastrophic and stupid and destructive to this country and despicable.
I might say
and
all
disgusting.
Of that boils down to the Lawrence Lessig argument that if only you were to reform campaign financing such that these interests couldn't then shape policy to their interest primarily via tax policy, you'd solve 9 out of 10 ills that the general population is concerned about.
And also, there's a Supreme Court Justice Brandeis some number of years ago, whose whole operating premise was solve the decision close to the problem. Like the further that the solution creator is from the actual problem, the worse the solution gets. And no one could be further from anything than the central government. And you compound that with the ego, arrogance, and giant budgets of our money. It's despicable. Shame on all of them.
And we may have just lost Chris.
We lost Chris. Yeah, we did lose Chris.
That is how emphatic of a point.
It was my use of the word here. Despicable.
That's right. That's how emphatic of a point.
Now that we're down to a two-man crew, my whole thing with you, Ilya, is
yes, sir.
Is balancing the Trump by the dip tariff piece with the inflation risk. Not to come back to that, but that's the thing that I'm actually most interested in from an investing standpoint, despite all my political ramblings.
I don't think that there is a strong case, at least in equities, to say that the Trump rambling about inflation being just noise is a reason to be long risk. I think what we're now going to do is, if the first 6 months of the year was tariffs, the soap opera, and that's noise, the second half of the year is going to be tariffs, the economic consequence. And not just tariffs, but among them tariffs. So there's tariffs and there's tariffs. There is tariffs, the thing that happens when the president types something out on his social media and goes, rah, 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 rah. More tariffs for you and more tariffs for you, and that's noise. And then there is the CPI data and the PPI data telling you that goods prices are starting to creep up. And that's real. So for that reason, I don't think that this situation lends itself to be a buyer of risk. I don't think that if you haven't been a seller near the top of this range, that this is a good spot to be a seller in, because you're at the bottom. And so the risk reward isn't great. So either you get a bounce back to retest the tops of the range. You already have that in NASDAQ. So that's now, I think, an attractive risk reward sell. If I didn't have it on, I'd get it on. S&P, I think, better. It's near the top, the upper half of the range with today's close. That's, I think, an attractive sell. Russell is not. It's closer to the bottom of the range, so I wouldn't put that on if I was putting something new on today. Though, again, I have all of these things on near the top of their respective ranges, basically saying the risk reward is risk goes down, stocks sell off, dollar goes up. And so in my mind, if you didn't buy dollars on the Powell kerfuffle today, maybe you missed a window, but maybe there'll be another. And anytime you see a meaningful sell-off in the dollar, probably until further notice, probably for the next several months, you buy that. And that's sort of how you do it.
Equities are entering a window now where after July 17th through the end of the month, they basically chop around. July 17th typically represents the last day of the bullish cycle mid-month for equities, and then they trade sideways to lower before in the final 2 trading days of the month poking through to a new monthly high. So I think if we're going to follow a seasonal path here, right, if that's informative in any context